Okay, so good afternoon, colleagues here at the NBS premises, but also online. Welcome to this SUERF and NBS joint seminar on macroprudential policy and at the end of the zero interest rate environment. I'm really glad that this is actually the first joint meeting with SUERF, but I hope that there will be more in the pipeline. And the topic is really important these days, since most of the big central banks are hiking, and it has an important impact on the financial stability, and we need to sort out the implications for macroprudential policies. And we do not have a lot of practical experience with macroprudential policies. Now we know at least half of the cycle when interest rates are very low, but we do not have extensive experience about the other half when interest rates are high. I do not want to talk too much at the beginning, but I wanted to flag four ideas how I am thinking about macro policies these days, and what are the limits and what are the advantages and costs of doing these kind of policies. So the first thing is that the institutional setup is important. Because we know that in countries where there are too many players around the table, it is quite hard to have flexible decisions and a state-dependent macroprudential policy, and we call it inaction bias, because these type of big bodies trying to avoid political pressures or impact on them coming from political circles. But we also need to understand that if we have just a standalone institution doing macro policy, even if it is independent, there can be an action bias there. So, they see crises everywhere, and they are using these tools extremely heavily because they are not responsible for the economy as a whole. They are responsible for financial stability. So from that perspective, I think putting macro policy inside the central bank is an interesting experiment, because here we have joint discussions with people who are dealing with monetary policy, macroprudential policy, and supervision, and it is much easier to put on the table costs and benefits of the various macroprudential instruments. The second topic I wanted to highlight is what I usually call waterbed effects. We are quite good at employing macroprudential measures in the banking sector, but there are other sectors which are much harder to control from a macroprudential point of view. And if we push the waterbed in the banking sector side, it can pop up at a different location, so risks can be shifted easily in the system, and that is important to understand. My third point is on hammer and nail effect. So if you have a macro instrument in your hand as a hammer, everything looks like a nail, and usually we forgot that not only the demand side is important, but also sometimes supply side effects. So if we just watch prices increasing on the property markets, partially it can be due to supply side reasons, and if it is that case, then managing the demand side will not solve our problems. We should look at other policies which are more in the hands of the government, like taxation, or at the municipality level, like zoning laws and so on. And my last point is in this introductory remark is related to the current environment, where actually we are discussing quite heavily the timing and sequencing of macroprudential instruments. So what is the right sequence to do? Because we know that in monetary policy, there is almost a general agreement about sequencing of different instruments like interest rates, QE, and other liquidity operations. But in the macroprudential framework, there is no such broad agreement. So from my perspective, we need to think more deeply about these things. So these are just four issues I wanted to highlight at the beginning. But of course, I'm not the most important person here. There are much more knowledgeable guests. And our program will continue with the keynote lecture, which will be delivered by Cornelia Holthausen, Director General, Macroprudential Policy and Financial Stability at the ECB. Then we will have two sessions. The first session is about global comparative perspectives, and which will be chaired by Fatima Silva, Head of Macroprudential Policy Division at the Banco de Portugal. And we have two distinguished guests there. The first one is Christopher Erceg, Deputy Director, Monetary and Capital Markets Department at the IMF, and Aaron Mehrotra, Principal Economist, Monetary and Economic Department, Emerging Markets at the BIS. And I forgot one more distinguished guest, which is Karsten Detken, Head of Division Macroprudential Policy at the ECB. Then we will have a short coffee break, and we will continue with the second session, where we will discuss country experiences and perspectives. This session will be chaired by Rainer Martin, our Head of Research at the Národná banka Slovenska. And the three guests there are from this region, actually Markus Schweiger, Director, Department for Financial Stability at the Österreichische Nationalbank, Marek Ličák, Director of Financial Stability here at the NBS, and my old friend Jan Freit, member of the board from the Czech National Bank. And now I would like to ask Cornelia to deliver the lecture. I realized when I was reading her CV that she is now for more than 2 decades at the ECB, and she's been involved in many different policy areas, which is quite helpful in these days where, it is very hard to separate monetary policy from market operations and even general economic policies. And Cornelia worked not only at the Macroprudential Policy and Financial Stability section, but also Director General Economics. She was a Deputy Director there and also Deputy Director General at the Directorate for General Market Operations. And she has an extensive publication record and also an extensive experience in these areas. And she told me privately that now she's at the right place because she always wanted to be involved in financial stability. So thank you, Cornelia, for accepting our invitation. And now the floor is yours. Thank you.
Thank you very much, Vice Governor, for the kind words. And thank you very much to the organizers for inviting me to this workshop on really, I think, a very interesting and very topical theme. So I'm very glad to be here. I hope the hybrid thing works. But I have the feeling that yes. So let me start my talk with a thought experiment. So imagine we are in 2007. And interest rates have been low for quite some time. And imagine also that just a couple of years earlier, the Basel Committee had introduced a new set of rules with the aim of increasing financial sector resilience. So they had asked the banking sector or let's say the governments to implement measures that would make the whole system more resilient should any type of shock occur. So, for instance, meaning that banks should hold some buffers on top of the individual buffers they were asked to hold by their supervisors. And now, so of course, countries started to implement them. It takes some time. Some are lagging behind. So luckily in the euro area, or the governments and regulators had been quite fast. So some of these measures had been implemented already. And yeah, then something unexpected happened. It's 2007, and all of a sudden, a market that had been stable for many decades, the mortgage market in the US starts to crash, and many banks are starting to have problems with subprime mortgages and so on. So what would happen there? So many of the homeowners walked away, leaving banks with NPLs, and they were not able to or willing to repay their credits. Banks had to react to this. Those who had more direct exposure started to sell their assets, fire sell their assets even in order to cope with the losses. But some other banks were in a good situation because they had capital buffers above what was needed for their individual purposes. So the whole banking sector as a whole maybe had a higher level of buffers. And that's because, in this case, luckily the regulators had seen before that there were some risks building up in the real estate sector, and they had asked banks to hold these buffers on top. So that helped. And central banks, of course, also stepped in this type of situation. They provided some liquidity because it's a market turmoil. But imagine they had been on a path to increasing interest rates. Maybe they put it on hold, and maybe for a couple of months, and then they could continue with this. So, of course, we know all of this didn't happen because Basel III had not been in place in 2007. And maybe if we had had a macroprudential framework at that point in time, we would not have experienced the financial crisis as what it is. So, of course, in response to the crisis, Basel III was developed, and since then we have a very broad macroprudential framework, at least in theory, not implemented everywhere, but ever since the financial stability aspect had also remained at the forefront of central bank thinking. So let me focus in my remarks today on why and how the ECB has also decided to take into account financial stability aspects in its monetary policy strategy. So last year, the ECB concluded the strategy review, looking at various aspects that are related to monetary policy. And in particular, it looked at this aspect of the connection to financial stability. So kind of thinking, what if ex ante we take it into account so that maybe ex post, after a financial crisis event happens, we are in a better place. So key results are summarized in an occasional paper that has been published on the topic. And broadly speaking, monetary and policy and financial stability interact with each other, perhaps a bit unsurprisingly, and therefore there are good reasons not to look at them completely independently, but to look at them jointly. So in the following, let me elaborate on two themes. So first, it's to better understand the interplay between the two, monetary policy and financial stability. And then second, to look more specifically at the policies that address price stability and financial stability, and trying to understand the interaction between the two. So how important is financial stability for price stability? Can we keep inflation rates stable when there are financial turbulences? And the other way around, if we have no price stability, what would this imply for risks building in the financial sector? And the answer of the strategy review is that both interdependencies are important and both are precondition for the other one. And that's why the review concluded that financial stability considerations should play a role in the monetary policy decision-making. And indeed, since then, financial stability has now obtained a more formal role than before by having regular presentations on the interaction in the ECB's Governing Council when they deliberate on their monetary policy choices. What are the type of issues that have been identified? Let me list three. So first, there are side effects of monetary policy on financial stability. Think of the bank capital channel, how the level of interest rates or the shape of the yield curve matter for bank profitability. Then secondly, could the medium-term orientation of monetary policy be used more systematically to introduce a leaning element in monetary policy if there are heightened risks to financial stability? And third, should monetary and macroprudential policies be intertwined? Should they react to each other? And in principle, these are two tools with two different goals, just like the Tinbergen rule tells us. However, there are interactions that are important, and we will go through of them later today. And finally, there's a more practical question, how to take these elements into account in the monetary policy decision making. And let me now go one by one through these connections. So on the first point that I mentioned, the side effects. The level of interest rates has some well-researched implications for financial stability, and it can go both ways. An environment of low interest rates, like we had for many years, may induce banks to search for yield and to engage in riskier activities. They can take more credit, liquidity risk, more duration risk, for instance, in order to gain some yield. And this can affect the resilience of the bank. And this would be an effect of systemic nature, as all banks are exposed to the same level of low interest rates. But conversely, an environment of high or increasing interest rates can also affect financial stability in a negative way through the balance sheet of creditors and by creating higher repayment needs. Now, coming to the second issue that I mentioned before, how to interpret the medium-term orientation of the price stability objective in light of financial stability considerations. And I copy here a chart that we had in the occasional paper. And with interpreting medium term, we mean kind of what is the medium term? No? Can we stretch it? Should we compress a little bit? So what is really the horizon that a central bank should look at? So, and the answer here, as is shown in the chart, it depends on two factors. First of all, are we in a state of exuberance in the credit cycle? And then secondly, where are we in the interest rate cycle? In particular, would we expect inflation to be below its target, that's the left-hand side, or above on the right-hand side? And the strategy review argues in a normal state where we don't see a heightened accumulation of financial stability risk, there's no reason to modify the horizon of monetary policy decision-making just for the financial stability purpose. But if we do see such risks, then the case can be made to either extend the horizon and allow for tighter monetary policy if inflation is too low, the left side, or to consider if inflation is expected to be too high, a somewhat shorter horizon, and to allow for much higher monetary policy. In both compared to a situation in which financial stability is not taken into account. So what would that imply at the current juncture, for example, where the issue is how and at which pace to tighten monetary policy? So if one considers financial stability, one could argue in the following way. Imagine the monetary policy normalization is rather slow. So looking at the left side here, meaning that interest rates move up very slowly and gradually. So this environment could be conducive to a continued building up of vulnerabilities and leverage. And there could be continued risk-taking, possibly the creation of asset bubbles. So that creates new risks. So think of the housing markets. If rates stay low for longer, it continues to be affordable to take out new mortgages, and exuberance in that market might be more persistent. And then imagine conversely that interest rates are tightened in a very fast way and faster than expected. And this could lead to an abrupt repricing in several markets. Think, for instance, about the fixed income market, and could also affect non-banks that have invested in certain type of bonds. And moreover, and this aspect is relevant in particular in the euro area, the risk of fragmentation across borders, country borders may arise in the form of higher sovereign bond spreads, for instance. So one can therefore say that there's kind of a short-term versus long-term financial stability trade-off that is associated with monetary policy. And we have several indicators that we look at regularly at the ECB to capture this. So in the upper chart here, we look at the SRI, our systemic risk indicator. And we see this here in this chart. So tighter monetary policy can mitigate cyclical vulnerabilities. As you see here, the response of the systemic risk goes down, but it has a more medium-term perspective. So it's in particular, the effect is stronger after several quarters. And the analysis also shows that monetary policy tightening usually leads to a decline in cyclical systemic risk over the medium term. And this reaction takes time. It reflects the gradual adjustment in economic and financial activity that is occurring in response to the surprise tightening. And if we think again about the housing market, you could imagine that if interest rates go up, then maybe fewer house purchases will take place. But the stock is still vulnerable to correction in interest rates. If we look at the lower chart, in the short term, monetary tightening can increase the level of financial stress. So this is a second impulse response function here. That's the KISS, our composite indicator of systemic stress. And you see that the economy and the financial system are then exposed to a higher level of systemic risk in an immediate way. So the effect is highest at the very beginning. Now, the third issue of relevance to the interplay between monetary policy and financial stability is the interaction with macroprudential policy. And this I will dedicate the second half of the talk to. So let me start by a definition. What is macroprudential policy, actually? So macroprudential policy is a policy that seeks to address or to mitigate systemic risk to financial stability by enhancing the resilience of the financial sector. And it does so with the aim of ensuring the ongoing effective provision of financial services to the real economy. So the goal is to, at the same time, to maintain a credit provision to the real economy wherever needed. Now, these capital buffers that are typically used in the macroprudential policy sphere, they ensure an additional layer of capital that banks can draw on when losses are incurred in periods of stress. And think of the example that I've mentioned at the very beginning. That was an example when the whole system was hit by a shock, but the level of resilience increased because the level of capital was high. So even if some banks may have been hit more severely than others, there was enough resilience in the system to cope for that. The various buffers that I will elaborate on the second slide, on the following slide, they are subsumed in the so-called combined buffer requirement. And there are some automatic restrictions on profit distributions, on dividends, on bonuses that kick in whenever a bank's capital ratio falls below this requirement. And banks take this requirement very, very seriously and really try not to breach that ever. So here I summarize some of the key macroprudential buffers in our toolkit. It's, as you can see, a quite comprehensive toolkit, and maybe you are just all too familiar with this. We have a number of capital-based measures. We have liquidity-based measures. We have borrower-based measures. Let me just point out a few that are really the most important one or the most discussed. That's a counter-cyclical capital buffer, systemic risk buffer. Of course, no one disputes the role that the liquidity buffers, the liquidity ratios have. And then finally, there are also borrower-based measures such as loan-to-value ratio, etc. So this is all Basel III related. So it's the type of measures that I thought could have been, if they had been in place in 2007, maybe we would not have had a financial crisis of that extent. Now, we always say that it's macroprudential policy, not monetary policy, that is the first line of defense against the buildup of systemic risk. And these policies, they can be targeted to underlying vulnerabilities somewhat. There are many caveats here. So it's an art to identify these underlying vulnerabilities and to design and choose the right tools and to calibrate them in the right way. Also, the timing of various measures is a challenge. Some take a long time to implement and then an even longer time to actually take effect on the economy. And it may not always be possible to be as targeted as desirable. And then finally, of course, the measures cannot always prevent or reduce lending in a downturn because there will be other factors at play. So clearly, macroprudential policy is not a measure that stands alone, but it has to be seen in the broader toolkit. And there are really complementarities between price and financial stability. So I think we can say that on the one hand, financial stability helps the pursuit of price stability because financial crises, for instance, that are associated with a sharp de-risking and deleveraging, they would make price stability much more difficult. So they would make the job of monetary policy makers much more difficult. But here we have prudential policies that can safeguard the smooth monetary policy transmission and thereby support price stability by preventing systemic crisis and also by increasing the resilience of the financial sector. And then on the other hand, monetary policy supports financial stability via a number of channels. And again, think of my example at the very beginning, where I think a liquidity injection by the central bank that could have helped in some way. So using monetary policy tools to calm down the market, but not necessarily changing the monetary policy normalization path. So as an example how both policies can complement each other, consider the current situation of a sharp expected monetary policy tightening. And what I show you here is on the left-hand side, the level of banks' current capital headroom and impact of the announced countercyclical capital buffers and sectoral systemic risk buffer increases. In the past few months, there were a number of countries in the euro area that had announced the tightening of macroprudential measures. And for instance, among those are Germany, France, and the Netherlands. And the chart on the left shows that euro area banks' capital headroom remains sizable. That's the blue bars in the chart, and most notably so in the buffer adjusting countries. And this allows banks to a smooth adjustment to higher buffer requirements. In principle, the additional buffer requirements are not very large compared to their capital headroom, so they did not have to raise new capital in order to comply with those and would still be left with sizable headroom. And the chart on the right shows results from model-based simulations to assess the costs and benefits of higher capital buffers. And here the left panel shows results for the hypothetical case in which there is a stress event once banks have accumulated more capital. And then this capital can be released in the stress scenario, again, a bit like in my example. And this would cushion the impact on lending and output and rendering banks more resilient to stress compared to a case when buffers had not been implemented. And you see here there's a positive effect on both GDP and lending of having implemented these different capital buffers. And then the right-hand panel indicates that the short-term costs in terms of lending and GDP would be contained, thanks in part to the ample management buffers. And at the same time, in the longer run, higher capitalized banks would default less often. The cost of a macroprudential tightening would also remain low in the case of a surprise increase in short-term interest rates of the 25 basis points that has been assumed here, because financing conditions will still be overall favorable. So to conclude, macroprudential policy can be an important tool to build up resilience in the financial sector. By reducing the likelihood and severity of financial stress events, it contributes to central banks' tasks to maintain price stability. And conversely, monetary policy can support financial stability by providing a stable outlook for price stability and by directly mitigating financial stress through monetary policy operations. Of course, we don't know what the future may bring in terms of crisis. I mean, who would have thought that in the past few years we had a worldwide pandemic, we had a war breaking out in Europe? But I must say, so far, so good. I mean, the financial sector, in spite of all the stress that has accumulated over the past 2 years, let's say, it has been able to withstand these shocks. And I think one reason is that we had this macroprudential measures in place, at least partially. Of course, there are many other factors as well. But still, we don't know what the future will bring, and whether the toolkit proves to be sufficient or not. I hope that the framework now is robust enough to prevent another occurrence of 2007. But we know there are also many challenges in the framework. Maybe the macroprudential policy makers don't understand the type of challenges that they should cope with. Maybe it's politically difficult to implement the buffers. Maybe we misjudge the time or the level that they should take. And there are also many gaps. For instance, you mentioned the non-bank sector. And think just of the events in the UK of last week. So the origin of the crisis, I think, was the fiscal shock that was caused by the government, which led to a sharp repricing. And that affected non-banks in a particular way for some, let's call it mechanistic or technical reasons. But here, again, monetary policy had to step in to provide liquidity. Maybe if we had had a macroprudential framework, this would not have been needed. And now the Bank of England, I assume they are not very happy that they had to give out more liquidity just at a point in time when they might have wanted to do the opposite. So communication-wise, it's a real challenge. So there's a lot to do still in the macroprudential spheres, and the interactions to monetary policy. It's clear that they are there and that we should cater for them. Let me conclude here.
Thank you, Cornelia, for this very interesting presentation and summarizing the framework we have in our hands. So I see that we have some time maybe for 2 or 3 questions. So if there are questions, please raise your hands. And Ernest. Just a second for the mic, because online they are not hearing you. Yeah.
Is specifically concerned with macropru in an environment of rising interest rates. But as we all know, we are currently facing several shocks from different sides and with different horizons. So climate is the other big topic. And in a way, the conflict in Ukraine also has anticipated some challenges from the energy transition. And some people say that we're already in the middle of a disruptive changeover to a different energy system. So how to square these various challenges put on macropru, from the rising interest rates plus the energy transition, sectoral shocks, how to square this all and bring this in one framework? Thank you.
Thank you, Ernest. Other questions? If not, then I will ask the second question. I also touched this in my introductory remarks that actually it is not so easy to come up with a kind of a sequencing of measures. What is the right sequencing in this situation where very different shocks are coming? Should we focus, first on liquidity measures in order to keep liquidity in the system? Because, if we are now increasing capital buffers, maybe it is already too late. Maybe this is the time we should gradually decrease them down. So I just wanted to know a bit more about your ideas, how ideally sequence those measures together with a quite substantial tightening of monetary conditions. So thank you.
tough questions. I wish I had the answer, of course. No, I think so. Ernest, first to your question. I mean, there's so many challenges right now. Actually, you know, when I prepared this talk, I thought I would come up with an example of the future where all kinds of things are happening, and I couldn't think of like a worse scenario where there's everything already there. No, we have had so many different types of crises. I thought everything else would sound ridiculous compared to a worldwide pandemic and so on. So, and the climate shock that I think that we are slowly experiencing in terms of the manifestation of physical risks. So I don't know the answer. I think how to square it in one framework. I think it shows that macroprudential policy should be comprehensive. So it should really try to be present in many different areas, because we see that if we focus, like all regulation, if we focus on one sector, there will be ways to circumvent it and to find cheaper ways of providing credit in the economy, of having financial flow. So I think we always have to try to watch out, and that's a very tough job, because also we don't have necessarily the data, or we don't have the understanding. Think of the whole crypto world, for instance. How can we as simple policymakers try to understand this very technical world and what it means for financial stability? So I think we always have to continuously learn what's going on there in the world, and then find ways to have a comprehensive way to regulate it. And I would tend to be more on the cautious side, and really, I mean, at the same time, you want to allow for financial innovation. So it's a tough choice to find the right way. And but I think we have a lot to do on the non-bank side, on the crypto side, and also climate. I agree. It's a very good case for having a macroprudential approach, because it's a macro problem. On your question on the sequencing of measures, I don't want to say really a lot, because my colleague Carsten Detgen will speak in the next panel, and I think that's the topic of the next panel now. So maybe I leave it to him if you allow, because he has also some slides elaborated on that. Because indeed we hear that. So we at the ECB, we have been thinking now for quite some time, whether it's now the right moment in time to increase capital buffers and macroprudential capital buffers, and we have had many conversations on that. And with the war in Ukraine, the situation changed a little bit. So we still see these very high levels of risk and exuberance. But at the same time, we are very cautious now, because we don't know what the future will bring. So I think it's a very, very delicate question. And personally, I would think we are still in a situation where we can raise buffers, because as I showed you on the slide that's still here, the management buffers in many countries, not in all countries, but in many countries, they're very high. So for me, we are now in a situation that is risky, but risk has not materialized. So why don't we please keep some of those buffers and avoid that they are being paid out as dividends and so on? Please keep them, so we can then release them when we really need it. That would be my approach. But I know there are also different views.
Thank you. Thank you very much. We also increased not many months ago our capital buffer, so it's in line with what you are saying, actually, to some extent. And yes, we should be cautious. So from one perspective, we should go slowly, because maybe we are going in the wrong direction. But on the other hand, these shocks are substantial in many markets, so we need bold actions sometimes. So it is really not so easy to, I can tell you, I'm also representing here also the monetary policy side. So from that perspective, it is not so easy to bring together all the considerations inside one framework, but it is much better than to have three separate discussions on three things, one on macro-proof, one on monetary, and one on the others. So I think there is a value in discussing these things together. And I'm pretty confident that also this seminar will have a value added not only for the experts but also policymakers as myself. So thank you once again for the interesting presentation and the discussion. And now I would like to invite Fatima Silva, the head of Macroprudential Policy Division from the Banco de Portugal, to chair the next session and introduce our distinguished panelists in the first session. Thank you very much.
So, good afternoon, everyone. I would like to welcome you all to this first section of this workshop that is dedicated to the theme on global perspectives, tightening monetary policy, what is the role for macroprudential policy. So for me, let me start by thanking the organization for inviting me here, and it's a great honor to share this panel along with these three distinguished speakers. This section will bring together the perspective of international organizations on the interlinkage and interdependencies between monetary and macroprudential policies in pursuing their main objectives. As you are aware, monetary policy with the objective of price stability, while macroprudential policy with the objective of financial stability. Framed in a context that is characterized by high inflation, normalization of monetary policy, and still high uncertainty economic outlook. This section, it will focus on the key analytical findings and also policy implications from recent research from a theoretical and an empirical standpoint of view. And as you know and are aware, the two policies work through the same channels, like the banking channels, and that interdependence will lead to some complementarities and trade-offs of each other effectiveness. So in the last couple of years, as Cornelia just mentioned, the focus has been on the challenge faced by macroprudential policy to address the risks posed by a very long for longer interest rate framework. A large body of empirical evidence has been produced showing the impact of monetary policy on banks and non-banks risk-taking behavior. More recently, the quick speed of normalization of monetary policy also brings other types of risks for financial stability, namely the increase in cost of funding that will affect most probably the ones that are more in debt. But secondly, as Cornelia also mentioned, it might even lead to some corrections in some financial markets, including the residential real estate. So in this set, we think that the tightening of monetary policy also may lead to different types of shocks in the medium and short term, and these shocks will affect financial stability. And for sure here in the euro area, it will be also some heterogeneous impact in different jurisdictions. So there is the need to clearly understand this interlinkage between the two policies, acknowledge their implications in the credit cycle, namely in the quality of the credit, but also in other asset prices cycles like housing cycle. In addition to that, I think that we should also see the impact in the business cycle from all this framework. The optimal mix of policies, from my point of view, will definitely depend on which phase of the financial and the business cycle each economy is, on the nature and magnitude of shock that we are seeing it, and also on the already implemented monetary and macroprudential instruments. That, from my point of view, would demand a huge unprecedented coordination among different authorities. Further, in the context of rising inflation expectations, I think that we need to adjust the indicators that we might be using to guide us in building up and releasing of capital buffers, or even we might think of recalibrating the instruments already in place. So how will optimal monetary and macroprudential policy mix will look like in near future, and what is the role for macroprudential policy are two of the questions that we try to discuss in this section. But first, let me thanks to the three speakers of this panel, so the Christopher Hurst, the Aaron Mehrotra, and Carson Deckerton, for kindly accepting to share their views on this topic with us. And also, thank you for attending this workshop. I think that the rules, some housekeeping rules, the sections will have three presentations of 15 minutes each other. And then at the end, we are going to have a Q&A section open to all the participants in the room and also online. If you are online, please remember to use the short mode. Having said that, today's first section will start with a presentation from Christopher. Include monetary and fiscal policy, financial stability, and open economy, macroeconomics, and he has been engaged in developing global macroeconomic models throughout his career. He received his PhD in economics from the University of Chicago. Today, he will give us some insights on the risks from rising interest rates to the housing sector and on appropriate macroprudential policies to contain these risks, relying on his role as advisor on developing macroprudential policy tools in IMF. He also tried to address whether any modifications are needed to address the challenge posed by this higher inflation. So, Christopher, thank you very much, and I give you the floor to you.
Thanks very much for the kind introduction, Fatima. Can you hear me okay?
Yes.
Excellent. So, good afternoon to everyone, at least those of you in Europe. So I'd like to begin by thanking the organizers for inviting me to participate in this really timely theme of the role of macroprudential policy in an environment of inflation-driven monetary policy tightening. So I'll address the topic somewhat indirectly by considering monetary policy challenges in the current environment and the financial stability risks that are likely to emerge or intensify. I'll argue that financial stability risks are likely to be heightened in part because of the central bank has less latitude to use its policy rate adjustment to stabilize both inflation and financial conditions, as central banks were able to do before COVID. So while ex post tools can be helpful, there's also an enhanced role, as I'll argue, for macroprudential policies. So the usual disclaimer applies, and if we could flip 2 slides, please. Good, next one? Yeah, great. So, of course, fighting inflation is the main task now of central banks. After a long period of quiescence, inflation has surged again almost everywhere and stands at multi-decade highs, as you can see at the right. Well, initially in goods and energy, most countries are now experiencing broad-based inflationary pressures. A number of factors appear to be key drivers of inflation, including massive monetary and fiscal stimulus, pandemic-related supply disruptions, and capacity constraints that became binding at the sectoral level. But inflation was surely a surprise, especially in light of the long history of low inflation and widespread perception that the Phillips curve is very flat. Next slide, please. For both the US and Euro area, in many advanced economies, inflation is expected to remain well above central bank targets next year before declining close to target by 2024. Output growth must slow substantially and unemployment's got to rise in order to bring inflation down. For this to happen, many central banks will likely have to push real interest rates well above their neutral rate, with these effects being reinforced by more tightening in financial conditions. Next slide, please. Thanks. So macroeconomic and financial stability risks will be exacerbated if inflation proves to be much more persistent than expected. Well, goods price inflation, including energy prices, could well come down pretty quickly. Inflation in services is likely to be a lot more persistent and harder to subdue. More persistent inflation would mean sharper policy rate adjustments. So the figure below shows a DSGE model simulation of what the policy rate hike might have to be in order to push down inflation 1 percentage point faster by the end of next year. And it indicates a nearly 300 basis point increase relative to the path currently envisioned. So in the US case, this will be 300 on top of the roughly 400, the policy rate of 4%. Well, this might be on the high side and reflect an overly flat Phillips curve in our model, admittedly. It's suggestive of the risk of a much larger output decline and disruptions in financial conditions if inflation proves more persistent. And as Gita Gopinath pointed out in her Jackson Hole presentation, some of the risks of persistent inflation could well run into the medium term if inflation expectations de-anchor to some degree. Next slide, please. Great. So the rapid shift from a lower for longer regime to much higher interest rates is itself unlikely to unleash substantial financial stability risks, given that risky assets were priced on the assumption that the lower for longer environment would essentially last on and on. And so less than a year now into tightening cycles, a number of pressures are already apparent. These include balance sheet strains for investors who assumed substantial leverage when yields were extremely low and now face much higher borrowing costs. Asset price declines, a rapid rise in long-term yields even on safe government bonds, which has lowered the value of their collateral and triggered margin calls. And finally, dollar appreciation, which has put pressure on a lot of EMs. Next slide, please. So one legacy risk is in the property sector. Even before COVID, low interest rates contributed to really large house price run-ups in many of these economies, as you can see here. Since the onset of COVID, these pressures have been amplified by demand for additional living space, even lower policy rates in real terms, and supply-based bottlenecks. But with interest rates rising abruptly now, house price growth appears to be slowing markedly or even turning south. Well, a correction in house prices through higher mortgage rates may be part of the desired transmission of monetary policy. There are also risks to financial stability. Higher mortgage rates could squeeze borrowers' ability to keep up with debt service, especially on the heels of a lot higher energy bills. And highly leveraged borrowers might have to rein in consumption sharply or default, potentially testing the resilience of the banking system. Next slide, please. The degree to which tightening financial conditions in Europe lead to strong reductions in spending or default will depend, of course, on a number of country-specific factors, including, for instance, the prevalence of floating rate mortgages. Well, Europe as a whole has shifted more to fixed-rate financing, and many European countries, especially in Southern Europe and some of the Nordic countries, mortgage interest rates continue to be financed mainly at variable rates. So it's still quite substantial. So there tends to be pretty strong pass-through from changes in interest rates. In adverse scenarios in which inflation is persistently higher and policy rates have to rise more, the effects on default and household consumption could be really quite pronounced. Of course, the ultimate effects on defaults depend on a range of factors, including the strength of the banking system. Next slide, please. Link 2. Great. So next turn to an important aspect of the current high inflation environment that affects the ability of central banks to mitigate financial stresses through policy rate adjustment. In particular, pre-COVID, central banks struggled to boost inflation towards target. When financial stresses emerged, central banks could reduce the policy rate or use forward guidance to reduce these stresses, as the Fed did in 2019. Insofar as these stresses would have put downward pressure on inflation if allowed to play through, these policy actions also supported price stability. Thus, pre-COVID, there was a confluence, some might call it a divine confluence, between using the policy rate to achieve both price and financial stability objectives. But in the current high inflation environment, there's likely to be a lot more tension between these objectives. Achieving price stability requires higher interest rates, but this may precipitate large increases in risks and term premiums that undermine financial stability. Such tensions are familiar from a historical perspective, and we know that from the work of eminent historians such as Barry Eichengreen and Michael Bordeaux. Under the gold standard, for instance, central banks had to raise interest rates sharply in order to defend the exchange rate parity, but this put huge pressure on banking systems. And the massive policy hikes under Volcker, of course, led to very large increases in borrowing spreads. Next slide, please. So one way to ease these tensions, is through the use of additional central bank tools that give them more latitude to use the policy rates to achieve desired macro outcomes, while also lessening financial stability risks. In this vein, the ECB has announced a new anti-fragmentation tool, and the Bank of England recently intervened in the gilt market to reduce financial stresses. Well, in both cases indicating that they expected to raise policy rates significantly to combat inflation. Next slide, please. One back. Just back one. Great. A key consideration is the effectiveness of such ex post tools. How effective are they in allowing the central bank to achieve their macro goals while keeping financial stability risks in check? The answers are important in forming our assessment of what should be done on the macro-pru side. The less effective and more costly these tools, the more that should be done in adjusting macroprudential policies. So before moving this, I'll first note the importance of devoting more attention to assessing how these ex post tools are likely to operate and how they may better achieve central bank objectives, including in stress scenarios. So to that end, I'll quickly illustrate some preliminary work that my colleagues and I have done to consider the potential benefits of the ECB's TPI tool, the transmission protection instruments, in the context of simulations of a quantitative GSG model. In particular, the key risk here is that policy rates hikes cause a disproportionate increase in periphery borrowing spreads. So we're going to consider asset purchases of periphery debt that can improve outcomes. And in particular, we're going to consider whether both periphery and core economies can benefit from this extra instrument. So we're going to explore this question in a two-country block version of a Euro area model that extends my work with Olivier Blanchard and Jesper Linde by including a financial accelerator, and is calibrated so that periphery borrowing spreads are more sensitive to rate hikes than the core. So the quick backdrop of this simulation is that a combination of adverse supply shocks that affect the euro area are broadly coupled with positive demand shocks in the core. So that's going to cause the ECB to sharply raise policy rates, as you see in the upper right panel. That's the policy rate path, goes way up. This in turn causes periphery spreads to widen, as you see by the red dashed line in the upper left panel. And that causes a disproportionate fall in periphery GDP, which is the in the left column, the second panel, compared to core GDP, which is in the third panel. So ECB purchases of periphery debt in this environment are going to cause the periphery spread, again, the upper left panel, the black line, to fall a lot relative to the case of no intervention. And that's going to cushion the effect on periphery GDP a lot, as seen in the second panel in the left column. So importantly, ECB can hike rates a little more quickly in the upper right And this benefits the core by reducing inflationary pressures. And the core actually ends up benefiting on our welfare metric. So the core would benefit even more if it was really overheating. But the upshot is that TPI can achieve a more balanced tightening across periphery and core. Next slide, please. Well, the simulation illustrates the potential benefits of ex post tools. There are a lot of limitations which make central banks put a high bar in deploying them. So these include the risks of even larger central bank balance sheets, possible tensions with monetary policy objectives, including in communicating that monetary policy must tighten when the balance sheet is expanding, as Cordelia mentioned. Moral hazard risks of reducing pressure for sovereigns and firms to reduce debt, and finally, political challenges. Next slide, please. Well, these ex post tools will help. The greater risks for macro and financial stability posed by high inflation raises the question of the appropriate role of macropru. This has both near-term dimension, what should be done now, as well as what applies in the more medium term. Here, given time, I'll focus mainly on the first and just say a few words about the latter. Of course, macroprudential buffers were released in many jurisdictions as part of the response to the pandemic, and we're just really rebuilding them in the last year and a half or so, as seen by this chart in the in the right panel. But some additional countries have taken actions more recently. For instance, Germany decided to raise its CCYB and also deploy a sectoral CCYB for housing. So the key question is if more buffers are more buffers needed now, and more generally, if resilience is required, what tools should be used to provide it? Next slide, please. So an important consideration coming out of the pandemic is it can make sense to move toward and maintain a positive neutral CCYB that can be relaxed if credit conditions tighten due to financial shocks. Recent research, including at the ECB, has found that capital measures have been useful to support banks' capacity to supply credit to firms, and there's strong evidence that they work because they can increase headroom over and above permanent requirements when capital takes a hit from actual or expected losses. So given phase-in periods, actions to build buffers now may only serve a limited role in the event of a significant near-term downturn. But nonetheless, it's quite arguable that even if there's a more persistent shift towards an environment in which there are more upside inflation risks and interest rates are considerably more volatile than the decade prior to the pandemic, these tools can be helpful. Having a well-capitalized financial system is particularly crucial in such an environment to maintain monetary transmission and to reduce downside risks. So good to move towards it. Moreover, it's arguable that the costs of building such capital buffers could be pretty modest, including based on extensive research by ECB staff, and Cornelia just presented some of this. In ECB work, including, for instance, work by Mendocino, highlights how the costs are greatly reduced when monetary policy can adjust to compensate. As in the current environment, in which monetary policy could just pump the brakes a little less firmly while still achieving the same desired tightening of financial conditions. So the path to building the buffers could still be quite state contingent, as Jan mentioned, so that the implementation could be paused if credit conditions deteriorate a lot. So if a tightening of broad-based capital requirements is viewed too negatively, then sectoral buffers could still be used in a constructive way, as has been done, as I mentioned, by Germany and also Switzerland. So slide 20, next slide, please. Almost wrapped up here. So turning to borrower-based tools, it's important for the authorities to work on expanding the availability of these tools, adding them to the toolkit where absent. An open question is whether it's still appropriate to tighten these tools in light of significant downgrades to the macro outlook and tighter global financial conditions. The experience prior to the GFC was that many of the worst loans were made right at the peak of the cycle. Even so, while there are differences across countries, my sense is that for many jurisdictions, tightening borrower-based tools at the current juncture could have relatively strong procyclical effects, potentially amplifying the downturn in housing, for instance, so you have to be wary. These adverse effects would be likely to have a lot stronger bite in credit growth and output than tightening capital tools. So even so, the authorities could issue soft recommendations to reduce the incidence of lending at high LTVs and DSTIs, and potentially reduce some of the tail risks. So to conclude, I've argued that financial stability risks are likely to be heightened in an environment of high inflation and large upside risks to interest rates, with central banks facing more complicated trade-offs in addressing financial stresses than prior to COVID. Building stronger macroprudential buffers can be helpful in containing these risks. Thanks. That concludes my remarks.
Thank you, Christopher. Maybe is there... Okay. So I think that we have some questions here from the room.
Can you hear me? We have a question from the chat by Fergal McCann. It is like this. In many jurisdictions, it seems that house price growth has been driven by a surge in pandemic liquidity and tight supply, rather than unsustainable loosening in lending standards. On top of that, bank capital buffers seem ample. Does this all mean that we should think much more sanguine about a potential fall in house prices and their wider amplifying role when compared to the damage post-2008?
I don't know if there is any more questions in the room. No? Maybe also from my side, Christopher, I would like to have your opinion relating to the interactions between monetary and macroprudential policy, namely, as you clearly show, the increase in interest rates and cost of funding for borrowers. And my question is, how should macroprudential policy react to that? Should macroprudential policy be thinking in a completely different way and take into account also other conditions like inflation, business cycle conditions, or from the starting point in order to calibrate the instruments? Or should we consider that the business cycle should only affect, for instance, the level of replenishment of the buffers, for instance? How do you see these interactions between the financial cycle and the business cycle? And the second question is that you tried to also to already answer to that is to provide some ideas, some tools that can be used in this current junction in order to reduce the use of exposed instruments by monetary policy. So going forward in future, do you think that it was a good way to have more integrated macro and monetary policy? Thank you.
Oh, well, thanks. Very good questions. I think on housing, we're certainly in a much better place than in the run-up to the 2008 crisis, where really there were undercapitalized banks. The sort of documentation requirements and other standards for approving mortgages were incredibly lax. And so you had, in many cases, for instance, in the US, mortgages that people defaulted on their mortgages at the first payment. So many loans were actually made right in the very peak of the housing bubble and almost immediately went into default. And so I think we've come a long way from that position. And I think really the enhanced stress testing of banks in particular, both solvency stress testing, liquidity stress testing have been invaluable in helping us better assess risks to key sectors such as housing, and to really make sure that capital standards are in place to help alleviate those risks. So I think we're in a much better position, but nonetheless, we can't be complacent. And I think that was a key message to me, certainly from the 2008 crisis, is no one expected that you would have a major financial crisis in advanced economies at that point. So we have to be attentive to potential risks, and that the risks might really materialize in a way that is quite unexpected. And with housing, I think the risks from my perspective are that you had very correlated developments prior to the pandemic, so prior to COVID, with interest rates being extremely low, fueling big increases in housing in many jurisdictions. And those were amplified then by lower rates in real terms, by large-scale fiscal stimulus, and by a shift in preferences towards housing, which didn't occur just in one country or a few countries as before the GFC, but in a wide set of countries. So it's an extremely correlated risk. And I think it's something that we really have to be quite attentive to, especially in an environment where interest rates are moving much more quickly than anyone would have anticipated even a year ago. So, certainly we have a lot of reason to be much more optimistic in light of the frameworks that we've put in place, and in particular that banks have very high capital levels, but we still have to be really quite attentive to potential risks. So that was one question. And then on macroprudential and monetary policy, I think the calibration of macroprudential policies, as I've mentioned just briefly, I think it certainly has to take account of really financial conditions in particular. And in that vein, I think that macroprudential policies were eased a lot in the COVID period, and we only kind of started the process of tightening these tools and rebuilding buffers, in particular the CCYB. So I see a strong rationale for moving back to rebuilding buffers in the current environment. But importantly, and this is to your question, Fatima, it's important to take account of cyclical conditions. And if there really is a downturn, then the process could be put on pause. So we really want to think about avoiding procyclicality in deploying these tools. And so we have to be quite attentive to that risk, particularly in a very volatile and rapidly changing global environment, where you see even the liquidity of safe assets being, in some cases, compromised. So then finally on ex post instruments, then I think my hope is certainly that we move back something more to an environment where inflation is quiescent and inflation risks are much smaller, and accordingly that there's less volatility in interest rates. That would certainly lessen the sort of tensions that I've described here. So that's really my modal expectation, is that we kind of return to a relatively low R-star environment at some point down the road, but it could be a couple of years hence. But there is a risk that, at least for certain countries, that inflation expectations become de-anchored, that inflation runs high. And in that environment, monetary policy will face more tensions between financial stability goals and achieving monetary policy goals. And so in that context, having additional instruments to be able to ease these tensions could be particularly important. I mentioned the ECB's anti-fragmentation tool, but really this was meant to be a much more general point. And during the tightening cycles in the 60s and 70s, the US, for instance, confronted these very same challenges because raising interest rates almost invariably has somewhat unpredictable effects on financial conditions. So that's a quick answer. I think we have a Q&A at the end of the sessions, and so there might be time for more questions then.
So the section will now move with the presentation from Aaron Mehrotra, Principal Economist on Emerging Markets section of the BIS. He has been in BIS since April 2011, And presently, his responsibilities including preparation of policy papers for central bank meetings and also research on international monetary and macroeconomic issues. His main research interests include monetary and economic policy, financial stability, and with a key interest in emerging market economies. He has published several academic papers on international monetary and macroeconomic issues. He received his PhD in economics from European University Institute from Florence. Today, he will share with us the role of macroprudential policy during monetary policy tightening and still high macrofinancial vulnerabilities in advanced and in emerging market economies. Thank you. The floor is yours.
So thank you very much, Fatima, for that kind introduction. Thanks very much to the organizers, to SUERF, to NBS for having me in this workshop, and in particular in this highly topical panel discussion. So my remarks will discuss the role of macroprudential policy in the current conjuncture of rising policy interest rates and at the same time high macrofinancial vulnerabilities, basically in both advanced economies and emerging market economies. So, and the usual disclaimer applies, all the views are my own, not those of the BIS. So let me start with just a few words about the current macrofinancial backdrop. So the conjunctural situation, high inflation, rising policy rates, that has already been well covered in the previous remarks. So I will not spend more time on those. But let me just note that these developments are taking place in the presence of quite significant macrofinancial imbalances that have been building up over time. So since the great financial crisis, both private and public debt have risen strongly, and so have house prices, as is shown in the panel on the right. Now, the COVID recession was also a highly unusual downturn in the sense that housing prices continued to go up, including in this region. Now, especially in advanced economies, the current macrofinancial environment is historically quite unprecedented. So prior to the mid-1980s, recessions used to be preceded by high inflation and then tighter monetary policy to tackle high inflation. And that's seen in the third and fourth panels in this graph as the blue lines. Now, at the same time, financial vulnerabilities, in the graph we show the credit gap and the broader measure of the financial cycle, those remained quite contained, as you can see in the blue lines in the first and second panels. Now, by contrast, since the mid-1980s, recessions have typically followed financial cycle peaks. So that's shown in red in the first two panels. Notice the significant rise in the credit gap and the measure of the financial cycle. But inflation has at the same time typically remained subdued, as shown in red in the third panel. So one could argue that the combination of high inflation now, high financial risks, and at the same time we have a risk of recessions today. That would make the policy interaction between monetary and macroprudential policy particularly important. So how did we get to where we are now in terms of macroprudential policy, and what was the experience with macroprudential policy during COVID-19? So in the years leading up to the pandemic, while emerging markets continued to be quite frequent users of macroprudential policy, the use in advanced economies also picked up quite significantly in recent years. So you can see the increase in the plain colored bars for advanced economies during 2015 and 2019. And that then also continued over the course of the pandemic. So as the pandemic hit, buffers were lowered significantly in both advanced economies and emerging market economies. Now, that loosening of macroprudential policy during the crisis was consistent with the experience from previous crises, especially for emerging market economies. Now, emerging market economies had already loosened buffers during the Asian financial crisis and then during the Great Financial Crisis. However, what was different from some past emerging market crises is that there was now a broad-based loosening of various policies, so also of monetary and fiscal policy. So this probably partly reflected the improved credibility of policy frameworks, and it also provided important support for macroprudential policy so that it could actually operate more effectively. Moreover, macroprudential policy now for the first time responded to a major shock, that is COVID-19, which was not due to economic or financial factors. And also one can argue that the ability to release buffers during 2020 really illustrates the usefulness of having accumulated them earlier, so during the good times. So working together with monetary and fiscal policy, Macropru was able to avoid a credit crunch and what may have been a much worse economic downturn. However, at the same time, the issue now is whether there is actually sufficient macroprudential policy space going forward. So buffers are now lower, and does it have implications for future financial stability? So what actions might macroprudential policy perhaps take going forward? So in some countries, as Christopher just mentioned, so buffers may be rebuilt post-pandemic to prevent the further build-up of imbalances and also to maintain macroprudential policy space. So advanced economies were generally more active in lowering regulatory capital buffers than emerging market economies during the pandemic. So perhaps in some countries we're going to see further adjustments in those. So in the left-hand panel in the chart, we show the level of the counter-cyclical capital buffer. So the releases can be seen in 2020, and then again some tightenings afterwards. Now, in some economies where housing sector vulnerabilities are still high, keeping macroprudential policy tight could help to further contain risks. So in that way, macroprudential policy would work together with tighter monetary policy. So that could be the case in some economies where house prices have reached new highs and household debt is also elevated. And the chart on the right shows developments in real residential property prices, and there's a much clearer upward rise in advanced economies than there is in emerging market economies. Now, that being said, there are trade-offs involved, and the economic and financial environment remains quite fragile, as was also mentioned in the previous remarks. And also the housing sector already appears to be turning now in some countries. So one would also need to be mindful in order to avoid an excessive tightening of financial conditions, if you like, with macroprudential policy. Now, conversely, if one was actually to loosen macroprudential policy now to offset some of the effects of tighter monetary policy on financial conditions, then one would still need to be mindful to pay attention to possible further buildup of imbalances further down the road. Now, economies where the combination of macroeconomic and financial risks would imply that both macroprudential policy and monetary policy would need to remain tight, they could benefit from the complementary effects of these two policies. In particular, maintaining a similar stance for macroprudential policy and monetary policy could strengthen their effects, given that they partly work through similar channels. So some recent contributions to the empirical literature show that in addition to containing financial risks, macroprudential policy may have broader effects on the real economy. side effects of macroprudential policy, if you like. So this graph uses evidence from panel VAR models estimated for advanced economies and emerging market economies. Now this is joint work with Professor So-Young Kim from a paper that came out earlier this year. So the graph shows the effects of contractionary macroprudential policy shocks in the left-hand side and contractionary monetary policy shocks on the right-hand side. And the effects on real GDP on the top row, on the price level in the middle row, and on a stock of real credit on the bottom row. Now, to be sure, comparable quantification is very difficult, especially when it comes to macroprudential policy. But the message from the graph is that the qualitative effects of contractionary monetary and macroprudential policy shocks are similar. So real GDP, the price level, and the credit, they all decline. So therefore, responding to high inflation with monetary policy and simultaneously maintaining or possibly rebuilding buffers through macroprudential policy would prevent them from working at cross purposes. Now, especially in some emerging market economies, the challenges are likely to be greater than in advanced economies, and the policy responses might also differ somewhat. Now, one reason is that emerging market economies tend to be quite sensitive to tighter global financial conditions, and these work in part through their exchange rate. Now, the issue then is that as emerging market exchange rates depreciate, the FX-related risks for these economies can come under closer focus. And of course, we are aware of currently the surge in the US dollar across basically a very broad-based range of currencies. So these risks have typically stemmed from unhedged foreign currency borrowing in emerging markets, what Christopher also mentioned, and then the related currency mismatches. Now we show FX debt by instrument in the middle panel and also as a share of GDP there. Now high levels of FX debt, once you have a domestic currency depreciation, that will then directly transmit tighter global financial conditions to the emerging market economies. But there are possible spillovers even when external borrowing is in domestic currency, as in the case of high non-resident holdings of domestic currency government debt, and that we show in the right-hand panel. So in this case, the currency mismatches, they move from the borrower to the lender balance sheets, but they can still have effects on credit supply through the lender's balance sheet conditions. Now, under these type of conditions, FX intervention, basically by selling FX reserve assets, it can work as a semi-macroprudential tool. So the idea there is to break the effect of exchange rate changes on domestic credit and domestic financial conditions. So in this, the increased accumulation of FX reserve buffers over time that one can see in the left-hand panel, that can be used. So then working on the exchange rate by limiting large depreciations, you can insulate the domestic economy better from tightening global conditions. So the reason, so the right-hand panel here shows that during some episodes of major shocks, so basically the taper tantrum, COVID-19, and then the recent tightening of global financial conditions, basically economies that had higher FX reserve buffers, they saw lower or smaller depreciations in their currency against the US dollar. So let me just conclude with a couple of points. Overall, I think the road ahead is likely to be quite bumpy. So while buffers may need to be strengthened in some economies, in some other countries, there could be still lingering effects of the pandemic or, further shocks, perhaps coming from the Russia-Ukraine conflict, that could work in the opposite direction. And that would then require further policy support. Yet, it does remain important to eventually regain macroprudential policy space so that one is able to respond to future shocks. And finally, in both advanced economies and emerging market economies, macroprudential policy is important, but it is not the only part of the overall macrofinancial stability toolkit. And it may be prudent not to place too high expectations on any one set of instruments. So to maintain consistency between policies and to keep them effective, macroprudential policy should be supported both by prudent monetary and fiscal policy, and perhaps in emerging market economies, even with additional instruments such as FX intervention. But let me stop there, and I look forward to the questions in the Q&A. Thanks.
Thank you very much. Thank you very much, Sharon. Maybe for this very interesting and fruitful presentation, maybe one question from my side. So you mentioned that there are a lot of things, features that we should take into account, the financial system, the characteristics of financial system, the level of development of financial system, legal system, and also how the economic agents also take into account the reactions to interest rates. And you came to a conclusion that macroprudential policy is just one policy in a broad toolkit. But let me ask one dimension that I think that I would like to hear your views is regarding, for instance, the impact, the differentiating impact from short and term horizon. Should we indeed still have to space in this time to implement also tightening macroprudential policy, or should we just consider the impact going forward, long-term impact?
Yeah, thanks a lot, Fatima, for that very important question. So I think, of course, the answer will depend partly on country circumstances. But so one issue with the macroprudential policy is that the tools typically take some time to take effect. So if you think about borrower-based tools, now, and to the extent that they are imposed on new loans, now if you tighten borrower-based tools at the moment, then it's going to take some time before it actually has any effect on sort of reducing future risks. Now, perhaps capital-based tools can, under some circumstances, work faster to build resilience. And currently, if economic conditions still allow it, so one could perhaps increase capital buffers without having a very big impact on credit supply and on sort of overall macroeconomic conditions. But I think overall with macroprudential policy, the key is really to take timely action. So once you are at a financial stress situation, you cannot anymore introduce macroprudential policy. So I think one key is to have sufficient macroprudential policy stance through the financial cycle. And one way to do that is perhaps to rely somewhat less on discretionary actions. So there are certain issues to use only actions at the discretion. One is that there is some evidence about inaction in terms of macroprudential policy. Now that can arise through political economy reasons, but that can also arise because sometimes it is just not very easy to identify financial risks in real time. So our models are still being developed, and it's not also always so easy to identify risks. So therefore, what one could perhaps do is rely less on time-variant tools, but maybe have more structural tools. So one could perhaps have a low LTV ratio, like a permanently lower LTV ratio in the economy, instead of adjusting it once risks become apparent. And that would actually also reduce the elasticity of lending to house price changes, for example, if one is worried about the housing sector. So there's less scope for lending to arise and to rise when house price increase if you have a structurally lower LTV ratio. And another way perhaps to reduce discretion would be to link the instruments more closely to some macrofinancial indicators. So similarly as one does for the credit gap, where one links the activation or the level of the counter-cyclical capital buffer to the credit gap. So one could consider doing something similar for other tools as well.
Any additional questions? So thanks once again, Harold, for this very interesting presentation. And so to conclude the first section of this workshop, we will have a presentation from Carsten Beckton, Head of Macroprudential Policy Division in ECB Directorate General Macroprudential Policy and Financial Stability. He had this division since 2017. The division is responsible for analyzing systemic financial stability risks at country level for all euro area countries, assessing the appropriateness of the macroprudential policy stance and possible suggesting additional macroprudential policy measures in line with the ECB mandate for macroprudential policy. The division also takes a leading role in analyzing the link between monetary and macroprudential policy in the context of the 2021 ECB's strategy review. Before 2017, he had the Financial Stability Surveillance Division of the ECB for 7 years. That was responsible for the ECB Financial Stability Review. Previously, Carsten worked for 12 years in ECB's Directorate General Research, and he also worked for 3 years at Swiss Bank Corporation and SPSC Bryson Institutional Asset Management. He had a PhD in economics at the University of St. Gallen in Switzerland, and he also published several academic publications on various topics, among which financial stability, monetary and macroprudential policy. Today, he will discuss from a more conceptual perspective whether macroprudential policy should focus on taming the financial cycle or on resilience of financial system, and what that means in the current situation. When vulnerabilities are still building up, monetary policy is on a normalization path, while we are still experiencing a negative supply shock. Carsten, the floor is yours.
Thank you, Fatima. Thank you to the organizers to have this very topical event. And it's also great to hear views of colleagues from other institutions on the very same topic. The normal disclaimer applies, so the views here are not necessarily one of the ECB. Let me quickly show you the outline, what I'm going to do in the next 15 minutes. So I will go to recap quickly the consensus on macroprudential and monetary policy interaction. We have talked about it already. And then ask the following question, which I think is derived immediately from this consensus. Would loosening macroprudential policy allow monetary policy to tighten more decisively at this point in time? And here the answer is definitely no. But it's state dependent. So I will argue that it depends on at least five arguments. And the conclusion will be that indeed, I think that it is still time to further increase resilience via tighter macroprudential policy stance in selected countries in the euro area. And this is fully in line with the ESRB warning, which was published just on 22nd of September. But let me quickly mention what I think could be a consensus. I would say most likely in this room. I hope I'm not too presumptuous here. But what is a consensus between the link between monetary policy and macroprudential policies? So I think we can agree that monetary policy can have effects on financial stability. I think we agree that financial stability is a necessary condition for price stability, at least in the long run. That monetary policy should take financial conditions and macroprudential policy stance and effectiveness into account. That the medium-term focus on price stability, for the price stability objective, would allow actually some monetary policy leaning against the wind. But we also know that the structural leaning against the wind policy is suboptimal. It often has two blunt effects. There's a lot of research on that. I think we all agree macroprudential policies are the first line of defense against financial imbalances or vulnerabilities. And we probably also agree that monetary policy could be the last line of defense, a term I heard last week at the New York Fed conference from Don Cohn. And I think that makes a lot of sense, possibly because macroprudential policy can be inactive, ineffective, or unavailable. So if you agree on this, I think a direct conjecture from this potential consensus is, and at least this was heavily discussed at the ECB at the time, that in a low interest rate, low inflation environment, macroprudential tightening allows monetary policy to remain accommodative for longer. Because macroprudential policy would actually deal with this potential side effects of a relatively accommodative or even very accommodative monetary policy. But now, what about the reverse? If you exactly reverse that statement, it would mean that in a higher interest rate, high inflation environment, macroprudential policy releases allow monetary policy to tighten more decisively. And that could be because macroprudential policy would prevent the financial amplification effects, the amplification effects coming from the financial sector, should, for example, capital requirements or lending standards become binding due to the effects of the monetary policy tightening. It could be, no? And I heard also some people, not yet in this room, not today, but some people arguing along those lines that it's the time to think about macroprudential loosening. As I said, my answer will be it depends, and definitely not at the current juncture. So let's just add some fuel to this argument of loosening. Here I just show you our 1 year ahead financial crisis probability on the left-hand side, and you see the average for the euro area, but you also see the country dispersion. And indeed, some of those countries, and even the average, is breaching the threshold, the optimal threshold for calling a crisis to happen within a 1 year time. And if on the right-hand side you have our more long-term SRI, Cornelia introduced it already, our systemic risk indicator, which is our favorite tool, and it's actually the official indicator we agreed within the Eurosystem to play a key role for the countercyclical capital buffer decisions. And this animal is declining. And if you look at the forecast at the end, you see forecasts of it, it's even declining further. So key message, we are definitely late in the cycle. That would be potentially an argument to say, yeah, what about loosening? But now let me go through these 5 arguments why this is, I think, would not be the right answer. First of all, if you look at the objectives of macroprudential policies, here I think the focus should really be on the resilience. Usually we have 2 objectives, right? On the left-hand side here you have the strengthening resilience and supporting credit provision in periods of distress. And the other objective is taming the upswing of the financial cycle. I think we have evidence that capital-based measures, of course, have an immediate effect once implemented in increasing resilience, euro by euro, dollar by dollar. But it has only a gradual effect on taming the upswing of its cycle. If you think about the mediocre increase in, for example, in financing costs, tightening of capital measures would be meaning for the banks. And for borrower-based measures also here, the effect on strengthening resilience is it's gradual because it's only working on the flow of new loans, but it's definitely there. While the effect on taming the cycle, the borrower-based measures might have to be really binding. And that's not how they're usually introduced. So I think both in terms of effectiveness and also in terms of priority, it should be the resilience, which is our key objective. And if you have that perspective, of course, the resilience objective would argue against the later release of a very late release, only when losses start materializing of capital buffers, for example. And the resilience objective also stresses the importance of preserving capital. This also had been mentioned before, and this is particularly relevant today. I've seen market predictions who expect a 70% payout ratio in Europe for the year 22-23. So there's quite some concerns about this, and a buffer increase, of course, would be a very elegant way to maintain capital in the banks. You're not imposing it. The healthy banks will be able to pay, but only those who can actually afford it. So that's the first argument why rather higher, not lower buffers might make sense at this point in time. Second one, there's evidence that household debt and firm indebtedness have been increasing over the last 2 decades in the euro area, and globally this is I think true also, at least on average. So we have several countries which really experience a rise in their household and NFC debt ratios, and the increase is sufficiently widespread that you can see it here even for the euro area averages between 2004 and 2012, 22, sorry. And also the dispersion to the upper side, at least definitely for NFC credit, is quite high. So we have these stock vulnerabilities which have been building up, and they're there, and they're not diminishing at the moment. Third argument would be, so what can we expect from the tightening of monetary policy in terms of addressing these vulnerabilities? Can we say that with the tightening, with the monetary policy normalization, these vulnerabilities will automatically be reduced? So you can go to sleep at the macroprudential policy side because monetary policy will do the job. And here I'm just showing you a couple of results from a recent BIVA model from colleagues at the ECB, the Duca and Rusnak. And the key message here is that we simulated here two scenarios. One would be a very strong tightening, so 3 times 0.75 further increase in the policy rates. They're actually using a shadow rate here. That's one. That's the red scenario forecasts, and another one would be just the unconditional forecast of the model, which would lead to about something like a one-time 0.75 additional increase in policy rates. And you see that indeed there will be effects on house prices. We have 2 different model variations. One explicitly considers CPI inflation, and the other one is termed in real terms. So you see the results are a bit model dependent as usual, but for sure there will be a moderation in terms of house prices, of nominal house price growth, potentially even turning nastily negative in the right model with the strong policy normalization scenario. That can be expected. I think that definitely makes sense. But if you then look at how does this translate into the vulnerabilities I mentioned, in particular the debt vulnerabilities, so debt to income ratios, depending on the model again, but in both cases here, this is relatively flat. So these variables, these vulnerabilities are moving slowly. And the reason is, of course, that there's also a denominator effect. So monetary policy tightening, of course, is also having an effect on income ratios, but only in the right model here, a bit stronger on debt than on income. But of course, if income is reduced, this maintains the ratio. So the vulnerability is really adjusting very slowly. So we cannot rely on the fact that monetary policy will do the job and reduce these stock vulnerabilities in the short term. A third element is how do we interpret our standard risk indicators we're all looking at in times of very high inflation? This is a very important issue because, as you have seen also at the beginning, this SRI risk indicator, which had very good early warning properties, by the way, is declining. It's forecasted to decline further. Here you see just on the left-hand side, residential real estate price growth and mortgage lending growth on the right-hand side, both in nominal and in real terms. And these of course, the gap is huge. Here we use just the CPI inflation rate to deflate. So what do I do with this in terms of when I want to assess whether the real estate market is continuing to overheat strongly, growing by 10%, or it's already collapsing? If I look at the real growth rate, I have to make up my mind here if I want to assess the situation. And this is just one example. We have many examples how our risk indicators are affected by inflation. We have to interpret them. The key issue here is that from a financial risk perspective, what would be most appropriate, of course, is if you would discount or deflate the indicators by disposable income growth. The inflation in disposable income growth. Because in the end, what counts is debt servicing capacity. And of course, at the moment, we see that due to the high inflation, the real income is declining even further. So how can I interpret the decline in such a real variable using a CPI, deflating by CPI, as a decrease in risk if real disposable income is collapsing? So that is very important, and we can show. I have many examples to take which deflator to use. Core inflation is also much better than headline inflation in this sense. Another issue, very related. That's not the only pitfall on interpreting risk indicators going forward. The other pitfall is looking at GDP. The GDP drop we observed in 2020. This also is distorting enormously some of our risk measures when you have the GDP in the denominator, like the Basel gap. There's an example on the left-hand side where in yellow you see this the Basel gap unadjusted for this drop, because the drop in GDP led to a spike, the yellow line, in the credit to GDP gap. There's also the trend depicted in yellow, a dotted line. And of course, the credit gap spiked and then fell down and became strongly negative again. Here there's a prediction. We make some predictions on how these developments can go forward. But the key thing is we're not only dealing with a sudden increase in credit gaps, we also will see in the future, in the next years, an underestimation of the credit gap because the trend has been affected. And you see, if you compare to the blue line, where we adjusted and kept the 2020 GDP at 2019 levels, whenever it fell below that, you see that you get rid of this artificial spike, and you also affect the trend. So going forward, we would have a very different assessment of credit gaps when we adjust for this GDP drop or not. The same applies, as I show on the right-hand side, with our risk indicator. Here it's called CCI. It's a similar version to the SRI. Where we would have similar effect, not coming from the trend, but similar effect because we also use ratios to GDP. And you can see that this is simulated forward also, that already in Q4 22, we would have, if we use adjusted variables, we would have a much lower CCI than if we adjust it, up to 0.25. This indicator is a buffer, is used also as a buffer guide for the CCYB. I mentioned that already in our framework. That could lead to this 0.25 CCI difference up to 80 basis points CCYB recommendation of difference. So that's massive. So you could have an 80 basis point CCYB too low if you don't adjust what we think is a correct adjustment. So these are important pitfalls we have to look forward to. And again, so let's not be charmed by the decline in some of these risk indicators due to the current inflation rates. Then quickly, last argument, but I can skip that, I think, because Cornelia mentioned that already also. So the current capital headroom, no? That's of course important. Banks have ample capital, they have voluntary buffers. Of course, often they are there for a reason, but still, this would really smooth adjustment if you would tighten capital requirements. Profitability is still there due to improvements in net interest income, so retained earnings are a possibility to also cover, at least still so far. That might, of course, deteriorate much further. But again, another argument not to worry too much about pro-cyclical effects of raising capital buffers at this point in time. And if you think about the opposite, a release of capital buffers would also not be effective because indeed there's enough capital headspace at the moment anyway, so it would just be ineffective. So to conclude, would loosening macroprudential policy allow monetary policy to tighten more decisively in this high inflation environment? Answer no. I revisit the objective of Macropru. Resilience is the key here. Keeping the preservation of capital is the important thing. The vulnerabilities exist. These are stock vulnerabilities in terms of especially indebtedness of the private sector. Let's not talk about the sovereign sector. Then, of course, the monetary policy will have only a slow effect on these stock vulnerabilities. We have to be very careful interpreting the risk indicators with high inflation. And we have the capital headroom. So to sum up, if anything, there's still scope to further increase resilience in selected countries, though, in line with the ESRB recommendation. And then you think, okay, is this perhaps just a nerdish, hawkish view from some ECB dude from Frankfurt? No. If you look at what actually has been going on in the real world, these are all macroprudential tightening measures. In red, EU as a whole. In blue, euro area countries. You see on the left-hand scale the numbers of tightening measures taken. And you see that also if you have February 22 as the start of the war, you see the economic sentiment indicator in yellow going down, collapsing. Nevertheless, many authorities have actually tightened their macroprudential policy stance. So I think we're not alone with this view. Okay, thank you.
Thank you very much, Carsten, for your very useful and provocative presentation, I think, because at least, macroprudential policy is a completely new area, quite recent, but we are learning with the experience. And I would like to see your opinions if you agree that at this present juncture, with a very high uncertainty economic outlook, with high pressure, expectations for high inflation, monetary normalization. So we macroprudential policy authorities, we should consider more weight on qualitative information than just having some tight rules in order to implement macroprudential policy. That I think it's why I say that it might be some provocative, because we try at the beginning, at least CCIB, to have a rule. So it seems to me that we are now in a position, in a moment where it's very important to take all the interpretation of indicators and see what they are saying to us.
No, I think that's a fair point. I think at the beginning there was quite some. Take an example: the CCYB and the buffer guides we have. We have the buffer guide from Basel with the Basel gap. I think including me at the beginning, very enthusiastic having such a nice buffer guide. Then it turned out there are quite some problems with this indicator, and I showed you one in case of GDP dropping significantly. We developed something better at the ECB. We came up with this SRI. It avoids some of the problems. Again, we get a quantitative buffer guide. Has also problems now. So then the tendency is, of course, you always fix. You come up with the next indicator. Try to fix one problem, but you create other ones. So taking into account, more qualitative information definitely helps. I think one has to be reasonable in interpreting the data we see. I guess that makes sense in all policy areas, but especially in a new area like Macropru.
Yeah, and definitely that will raise some communication issues, because we came less predictable than we were supposed to be. So I don't know if we have some questions from the speakers we have already in the room. Yeah.
For this excellent presentation, as always. It's always a great pleasure and a big lecture for me, a big learning experience when I listen to you. Now, it is a commonplace now among some observers that monetary policy may be behind the curve in many jurisdictions. Now, given what Aaron showed us on real estate developments in the advanced economies, of course, we could ask the same question for Macropru. Is Macropru behind the curve?
Thank you very much. I have also a question to Carsten, but maybe Aaron and Christopher may have some views on this too. So Carsten, you quite strongly, convincingly made the point that this is not the time now to release capital buffers. Maybe we actually need more of them going forward. But maybe could you elaborate a little bit more also on other macroprudential tools? So what are your views, for example, on liquidity measures or also on borrower-based measures? And I think that relates a little bit to Ernest's point, whether macroprudential policy, at least in some parts, is behind the curve and whether it's still the right time to actually catch up, so to say, also on these tools.
Also, one question on my side, basically two. First is that to whoever who would like to answer. First, it's related to the indicators we are using as buffer guides or indicators used to set borrower-based measures. You also showed indicators that we usually use when we decide about tightening. Question is whether we shouldn't we use two different types of indicators, one for tightening, one for easing, because usually when we discuss it within the bank, easing is related to different variables like credit losses and so on and so forth than when we discuss tightening. And the second question is related to a more broader issue. I mean, we are now talking about environment of high inflation, whether we should distinguish between high inflation due to supply shocks and high inflation due to demand shocks, and whether you see a different role for Macropru or a cooperation of Macropru and monetary policy between these two different words. Thank you.
We have one question from the chat by Fergal McCann. I read it out. Carsten didn't mention explicitly interest margins, I think, and the likely boost that they will provide to bank profitability as rates rise. This should further increase scope to tighten despite the economic outlook deteriorating, because this downturn should be less severe for banks than a downturn with low for long still in play. Does this factor feed into Carsten's policy thinking?
Okay. Okay, and Macropru behind the curve. We're a bit late, but I think many authorities would have been earlier if it wouldn't have been for the war. I mean, you see this chart, there has been quite some action nevertheless. But I think if the war would not have happened, most likely there would have been more macroprudential policy action. And then you come in this conundrum that on the one hand, the situation is deteriorating, but you see the vulnerabilities, you see the risks, you see even a higher likelihood of risks being triggered. And then you have something which is called a countercyclical capital buffer, supposed to be countercyclical. Of course, it's a difficult situation for a macroprudential authority to say, yeah, I still use it now, even we're late in the cycle, and open up for difficult communication issues. Also because the risk is that you have to release it very soon if the risks are materializing. So probably these concerns have led a bit to the fact that perhaps we're a bit behind the curve, but I think without the war, that would have not been the case. I mean, there was a similar consideration in the earlier days of during the times of monetary policy loosening. No? So the macroprudential actions on the capital side were relatively late in the game. So when we started loosening significantly, let's say 2016, I think we had negative rates. At that time already, there were concerns that risks were building up in the financial sectors, and whether Macropru shouldn't tighten more. I mean, there were some accusations Macropru is behind the curve, because then capital buffer, the CCYB was used, I think, more extensively by 7 euro area countries in 2018, but not before that. And then the cycle was already nearly turning again. But there again, I think it was also I would not agree with that completely, because at the time, following the great financial crisis and the Basel III was implemented, we had a high increase in the quality and size of bank capital already from macroprudential supervision. Macropru was more focusing on the structural buffers first, not so much on the cyclical. So there was not much appetite to tighten capital requirements even further. In a time when monetary policy was trying to enhance risk-taking, right, and support credit supply. So I think it didn't fit at the time. But perhaps that's something one can debate. And now we are. It could have probably would have happened more earlier if it would not be for the war, which is a legitimate concern, obviously, for being careful. Then on Rainer, other tools. Are we they're also behind the curve. I mean, the borrow-based measures is, of course, is one thing, and we distinguish. So we distinguish that, of course, you would use a tool like the CCYB when you have broad-based vulnerabilities building up. You have, for example, both household and NFC credit growth, exuberant, leading to higher debt ratios, or when you're concerned that risks in the real estate market would spill over because people would never default on their mortgages, but just reduce consumption. So then it could spill over to the broader economy. In that case, the CCYB would be the most appropriate tool. But we also have countries where we see, it's really contained in the residential real estate sector, and we see lending standards deteriorating over the last years. So in that case, of course, yes, it would be borrow-based measures, which could be employed, but you would have to see really this deterioration in lending standards, because that's what the borrow-based measures are for, to contain those risks. If it's just for a build-up vulnerability like indebtedness, then of course the capital-based measures are the ones. So I think there are quite a few countries actually which have implemented borrow-based measures now. So I wouldn't say perhaps we're less behind the curve there. Then to Jan, you said about the high inflation. Does it make a difference whether there's a demand or supply shock which is driving inflation? I think, of course, for monetary policy, it makes a huge difference. So the monetary policy reaction will be, of course, could have a potentially even a different sign. But for Macropru, I don't think so. There, the key thing is, okay, we observe this inflation. Let's be careful what that means for our indicators. Let's be aware that there's a difference between inflation in expenditures and inflation in income. And if there's a difference between the two, we have to be careful what we use to deflate our risk indicators, our scoreboards. I mean, our scoreboard is fully in real terms for the residential real estate, for example. And also, we have to be very much careful how we adjust those indicators. But otherwise, I think it's let's look at the inflation, how it affects our indicators, and how the overall situation makes sense to interpret them. I think that would be the key thing. You had another question on I don't know whether you can repeat that, on the tightening or the easing. Sorry, I got it.
Whether there should be different indicators.
Whether there should be different indicators when for the build-up or the release of instruments. Definitely. No, I mean, for the build-up, we need those indicators which have a good early warning property, kind of predicting financial stress or crisis. For the release phase, if you buy my focus on resilience, then I think it's relatively clear. I think when you see when the losses are coming, when the loans are transferred through the IFRS 9 stages. You see when the NPLs are rising, when losses are materializing. So that could be relatively late in the cycle when you release. And I think it's easier to see a crisis when it's happening than to definitely to predict it a few years ahead. sure, the indicators will be different. And then there was one on from the chat on the interest margins. No, I think I might not have mentioned it. That's true. But if you look at this chart on the right-hand side, we actually look at the profitability. And this is the net interest income of banks in percentage points. And indeed, this has been significantly improving recently. And this is one of the arguments also why we think that higher capital buffers could be covered by retained earnings for many banks, for most banks at the moment. This is, of course, also changing most likely. But at the moment, this is indeed a strong additional argument to not to be too much afraid of pro-cyclical effects of potential further tightening of macro-pru. Thank you for the questions.
Aaron still has one question.
Yeah, if I may, can I ask a very short question? I was intrigued by your financial crisis early warning indicator and that it has changed recently. So what is driving that change? Is it the interaction between private debt and interest rate increases, or is there also some issue with GDP decline actually distorting that picture?
Exactly. So there is some there. I mean, on the right-hand side, so this is our long-term early warning indicator. It's composed of the components which you see there, and you see also the contributions. And you see, for example, that what is keeping up the risk is at the moment is the residential real estate price-to-income ratio as one measure of valuations in the market. That's still keeping up, but all the other things in terms of bank credit changes it's actually the red changes in the bank credit to GDP ratio over 3 years. Of course, that is collapsing now. There's also a base effect here because, as I said, in the year 2020, there we saw quite strong increase in lending. So those 3-year changes now are turning slowly negative. So it's definitely a bias to the downside, I think, at the moment of this indicator. And it's a stylized fact, by the way, that this thing is the crisis usually happens 4 to 6 quarters after this thing has peaked, the SRI has peaked, which would not be a nice message now, but.
I don't fully understand the meaning, but I'm sure you experts will. The question is like this: shouldn't we dissect, so differentiate, separate more clearly, an ex-ante brackets preemptive macro-pru from an ex-post macro-pru in order to calibrate the interplay between macro-pru and monetary policy?
Who wants to react to that question?
So let me take a shot. So thanks for that question. So I think financial imbalances are very low frequency movements, right? So I think macroprudential policy is all about building resilience and avoiding that these imbalances are formed in the first place. So I would see less role for sort of ex-post intervention in terms of macro-pru. I mean, of course, when conditions worsen and when the financial cycle turns, there is definitely a role for releasing capital buffers, and they will help. So banks can absorb losses and they can continue lending, and that's very important for the real economy. But I think overall, sort of ex-ante having a sufficient sufficient macro policy stance through the cycle is very important.
No, I think the role of monetary policy is very different. I mean, I understand with preemptive and exposed so preemptive during the build-up phase of financial vulnerabilities and exposed during the risk materialization phase to the So in the preemptive phase, of course, the role of monetary policy, as we said before, it's not it shouldn't primarily target financial stability. It should take financial conditions into account, yes, but it's not really a primary role. There's no leaning against the wind role on a structural basis. It would only have that role when indeed macroprudential policies, the first line of defense, are not used, cannot be used in this certain sector because the tools are not available, or they're not effective because there's leakage. In that case, of course, monetary policy might consider, and if you think about the example of 2006, 7, 8, where, some people argue if monetary policy would have been a bit tighter at that time, it could have had an impact. I think there was a nice paper by Adrian and I think Shin in the Jackson Hole 2008, where they showed that this business model of these SPVs, of the special investment vehicles, was so vulnerable on the slope of the yield curve. And so if you would have flattened the yield curve a bit with 25 more basis points, 50, the thing could have turned out differently. So I think in the build-up phase, so usually there's a limited role for monetary policy, but occasionally, let's say as a last defense line, as Cohn put it also, because at the time there was no macro-pru, obviously. But while in the post phase, ex-post phase, so the crisis materialization phase, usually there monetary policy is intervening quite a lot. And that might actually be a problem now, because the question is, what would monetary policy do with such inflation rates if something would happen? But usually I think there's more consensus on strong policy reaction when the crisis is materializing. So yes, there's a different calibration of the interaction.
So Christopher, would you like to add something?
Not a lot to add. I think those were very complete answers. The only aspects that I might mention are that if there are really gaps in the macroprudential framework, for instance, if it's very difficult for macroprudential tools to address the challenges posed by non-bank financial intermediaries, then that would be an added reason for potentially using monetary policy to curb excesses. But it would complement the answers given. The other is that the question might have in mind that if there are more difficulties with using ex post tools, so policy rate adjustment and other sorts of balance sheet actions by central banks, then I think consistent with what I was saying earlier, then it would make sense to put in place macroprudential policies that are stronger to help really alleviate those sort of situations from arising. So less ability to use ex post tools means more macro-pru policy.
Okay, I think the person still has a question for you.
Yes, Christopher. Just a couple of questions on your presentation. I like the model you used to show the usefulness of the TPI, our latest policy instrument. And you mentioned also the caveats, that of course what this could mean for the central bank balance sheet, for the monetary policy objective in these times especially, and put also central bank independence. Do you think that the conditionality, of course, which is coming along with this instrument, that these address these vulnerabilities, or there hasn't been done enough, or these risks remain? Would be interested in your views on this, because again, there has been some conditionality announced on the use of these TPIs. And another question, just on you had a recommendation on the borrow-based measures, that there are potentially some soft recommendations would be a good idea. I think to remember that we made in some of the euro area countries not very good experiences with soft recommendations in terms of banks' adherence to them. So the question is whether it would not be better to impose binding borrower-based measures, but in a sense, legally binding, but not binding in terms of the economic effects at this point in time. So you use them as a backstop. You put them a bit on the softer side in terms of the level, let's say, in which you use them. Or you also allow some exemptions, these so-called speed limits, but you make them legally binding. That's just so interested in your view on this.
Well, those are two good questions. Of course, the TPI is a new instrument, and I think conditionality is very important. I think the Governing Council readily recognizes that. But given I think that it hasn't been tested, then it's hard to really make an assessment whether conditionality is sufficient. I think the difficulty is to make sure that the instrument, like any instrument, serves its purpose during a crisis episode, but is wound down subsequently, so that it doesn't result in a very persistent rise in balance sheets. And I think my sense is that the Governing Council is very attuned to these sort of risks and is trying to minimize the possibility that really the tool results in more permanent balance sheet increases. But of course, this is a very nascent stage, and so I can't say much more on that. In a few years, we might know. Now, I think in terms of the borrower-based tools, I think in line with what you're suggesting, it would really be the objective to convey that although there would be concern about using these tools to in a way that would be pro-cyclical, so you don't want to do that, nonetheless to indicate that it's the objective to make sure that you lop off these sort of tail risks, that you have a lot of problems emerging kind of late in the cycle. And so I think your recommendation would be very much in the spirit of what I have in mind. I kind of went through that very quickly, and I think just mentioned soft recommendations. But I think something that would be legally binding and essentially pose a cap on allowing say high LTV loans to go through. Making sure the documentation requirements were good, and that we didn't get the sort of problems that were observed before the global financial crisis. So that would be the idea. So you want to avoid procyclicality, but at the same time make sure that you minimize these sort of tail risks. So I think that's a good way of putting it.
Right. Makes sense to me. Thanks.
So we might conclude. Thanks very much for everyone for attending this section, and we have now a coffee break.
All right, welcome back, ladies and gentlemen, for the last session of this workshop. So after the more European and global perspectives, we're now zooming in for some country experience here from the region. So we have representatives from 3 different countries, Austria, Slovakia, and the Czech Republic. And you may think, well, they're pretty similar. And yes, all 3 of them are beautiful, medium-sized countries in Central Europe. But there are a lot of differences as well. And these differences are actually quite important when it comes to the topic of our seminar, our workshop today. So first of all, of course, they have different monetary policy regimes. They have also been quite diverse in their approach towards macroprudential policy usage. And that partly also reflects, I believe, at least, we will find out more about these different institutional settings, as we discussed already this morning. And last not least, given that macroprudential policy is often about housing markets, they have also quite different housing market structures. So if you just think about Slovakia and Austria, for example, the housing market could hardly be more different. So all of these things shape, of course, the country-specific experience and perspective on the issues that we are discussing today. So let me introduce the 3 panelists, and I'm very happy to have these 3 gentlemen here on the panel. Let me start directly on my left. So Mr. Markus Schweiger. Markus has joined the Austrian Central Bank in 2003, and he is currently responsible for the ÖNB's financial stability work. So he's the director of the Department for Financial Stability and the Supervision of Less Significant Institutions. So before that, he held various managerial positions at the ÖNB, mostly in the field of financial stability. Markus holds a PhD in finance from the Vienna University of Economics and Business, the Wirtschaftsuniversität Vienna, and he is also an associate professor at the Department of Finance and Accounting there, and he is adjunct professor at Webster University, also in Vienna, and he has lectured at the University of Innsbruck. How do you manage all of these lecturing? It's very impressive. Then we have Mr. Marek Ličák. Marek is Director of Financial Stability here at the NBS. So he is responsible for macroprudential policy in the NBS, and that, of course, includes a whole range of activities, the implementation of macroprudential policy, but also everything that comes with that, so risk analysis, the policy decisions, the communication of the policy decisions, and so on. So that's a very wide range of topics. He is also, and like Markus, of course, he is a member of various relevant committees, so the Financial Stability Committee of the ECB, the ATC Committee of the ESRB, and so on. He also worked as a consultant and technical advisor in a range of countries, so Ukraine, Belarus, Tunisia, and Vietnam. And Marek has a PhD from the Slovak Agricultural University in Nitra, and he also has a master in banking and finance from Ghent University. And then last not least, on the left-hand side, we have Mr. Jan Freit, who was recently reappointed as a bank board member of the Czech National Bank, 1st of July. So before that, he already served as a board member in the early 2000s, and then he has a long career basically running more or less the financial stability functions within the CNB. He graduated from the Faculty of Economics in Ostrava, Technical University in Ostrava, and completed also his postgraduate studies there. He is a professor there, and he is also the editor of the Czech Journal of Economics and Finance. So, very distinguished panel, and we'll proceed slightly differently. So we have 3 presentations, one after the other, and then we take a joint questions and answer sessions. So, Markus, if you would like to start. Thank you.
switch the microphone. Thank you for inviting me and having me here. What I would like to do is to give you a little bit of an overview in terms of how we think about macroprudential policies, in terms of the railguards we try to observe in policymaking, and then have an illustration of that by means of a couple of recent decisions that we have made. In terms of the framework we are thinking of, we try to achieve consistency of ex-ante systemic risk analysis and exposed crisis management, in the sense that what we want to achieve is a situation where banks, which in the end at some point need to be resolved and are, because they are of public interest, these banks need to have a buffer that they hold, be it an OSI buffer or a systemic risk buffer. And that then also has implications for the size and the design of the deposit guarantee system, which of course has to cope with all the other banks. Now, within that framework, what we try to adhere to are a couple of principles, very simple. One is, and the first one is resilience. I think that as macroprudential policymakers, we are like fund managers. Fund managers are very bad in timing the market. And I think we are very bad in the micromanagement of cycles. So I think what macroprudential policy should be about is really achieve a level of resilience that you as a policymaker are comfortable with. Second, I think systemic risk needs to have a price tag in terms of additional capital a bank needs to hold if it incurs systemic risk for the system in order to provide the right incentives. Third, we have, I think, expanded our toolkit over the last 10, 15 years quite substantially. Before we, if at all, just had capital buffers. Now we have a number of other tools, including borrower-based measures, and I think we should use these tools in the most targeted fashion, in the sense that if we do see a problem in one segment and we do have a tool available to address the problem specifically, we should use and have a preference for this tool rather than being too broad. And last but not least, and this may be a little bit more of an Austrian-specific issue, in Austria, we have a banking system that is to quite some extent, or has to quite some extent, cooperative banks. Now, why do I mention these? Cooperative banks are banks which do not typically have access to external capital. Now, what this means is that it takes time for you as a macroprudential supervisor to build capital buffers, and once they are gone, it's quite difficult to rebuild them. Much more difficult than in a situation where you have commercial banks that are traded and can raise capital in a much more in a much easier way. That's why a steady hand is something we try to observe, and that's why we also tend to have a clear preference for structural buffers compared to cyclical buffers. Now, let me illustrate how we try to. And I may say tried, because I'm not sure we achieved everything at every point in time, but how we tried to adhere to these principles by mentioning three decisions that we took over the last 2 or 3 years. Starting with COVID, then a recent decision on the increase of structural buffers that we made this September, and finally, I would like to spend a little bit of time on the introduction of borrower-based measures that we also did this year. Now, starting with COVID, how did we approach the COVID situation? First of all, I think we were in the process of increasing capital buffers right before the COVID pandemic broke out. And we didn't do it in the end because of all the uncertainty that was involved. It was just too unclear how this thing is going to unfold. We didn't increase buffers, but we also did not release them. We chose instead to actively communicate both to the market and to banks that capital buffers are not an end in itself, but are there to be used. And in a situation like the COVID pandemic, we actively encouraged banks to use their buffers. But we upheld it because we had the conviction that even if parts of the risks we thought might realize do realize we would certainly never end up in a situation where we would say all the systemic risks have gone and no need for any further buffers. Now, does this mean that we would never, ever have thought about releasing structural buffers? I don't think so. I think especially if a tail event would have occurred where we would have slipped into a credit crunch, a massive credit crunch, that would certainly have been a situation where we would have changed course. But things turned out dramatically different, I think. The COVID problem, at least in terms of the banking system, in terms of insolvency for the real economy, did not go the way we all thought it would go. I mean, we had, I think all of us, very bleak predictions at the beginning of the COVID pandemic, which turned out to be false because we basically had a very broad government intervention that prevented things from going bad. And I think that was part of the reason why, at least in our case, I think things went well. We preserved the rating and the financing conditions for the banking system and also for the real economy, I think at very well levels, very good levels. Credit supply remained strong throughout the pandemic, so I think it went well. Second thing, the recent decision on increasing capital buffers, just to go back a little bit in terms of the history of setting systemic risk buffers, OSA buffers in Austria. Austria is one of, I think, rather few countries in the euro area that did set a systemic risk buffer relatively early on, already in 2016. And it was relatively successful in increasing capital levels at that time, as you can see in the middle chart. What we did observe over the last couple of quarters, however, was a situation where strong credit growth, both stemming from the housing sector and the corporate sector, was, I wouldn't say eroding the capital base, but it led to a slight dip in capitalization levels, also compared to European peers, as you can see on the right-hand side. And this led us to the conclusion that given the systemic risks that we still think are present in the Austrian banking system, we needed to provide more incentives for banks to increase their capital level. And as I think Carsten has spelled out very eloquently, I think the timing is in such a way that we are still confident that banks can reach this without there being any risk of massively pro-cyclical events happening along the way. We also discussed, although these are not, of course, perfect substitutes, but we also discussed, of course, how counter-cyclical buffers the interplay of counter-cyclical buffers and structural buffers. As I've said early on, we do have a preference for structural buffers, and this was also one of the reasons why we finally opted for the structural path rather than the counter-cyclical capital buffer. My third example is the introduction of borrower-based measures, which is something we also did this year. We announced it at the beginning of the year and finally introduced it in August this year. Here too, let me give you a little bit of a context of the Austrian housing market. It's, as Rainer has already alluded to, a rather special market. Especially in its microstructure, because we have a large importance of renting and a large importance also of a cooperative housing system. But it is also special in the sense that it is a very stable market. It used to be a stable market. And stable meaning not over the last 10 to 15 years, but over the last 50 to 60 years. Austria never experienced a housing market crisis. We always had very low default rates, and we always had relatively conservative underwriting standards. And this is, on the one hand, a problem in the sense how people think about housing, because for them, the housing market has been always a market where maybe you never gained a lot, but you certainly never lost money. And also the situation, I think, changed with the monetary policy conditions which were, of course, very loose over the last couple of years, trickling through the financial system into the housing market. And as you can see here on the right-hand chart, over the last 10 years, housing prices in Austria more than doubled, a lot more than what we observed in the euro area. And we had a little bit of a vicious circle, let's call it that way, with very high lending growth in the residential real estate market, fueling prices, which again, of course, were a reason for people to take out more loans. And this was accompanied also by an erosion of lending standards. And that's where we thought that it is appropriate to think about macroprudential measures. We had the choice between capital-based measures and borrower-based measures. Finally chose the borrower-based kind because, as I've said, the stock of lending is still something where I think the quality of the underwritten loans is acceptable. The problem is more with the new production of loans. And we explicitly wanted to have a measure which prevents over-indebtedness and reduces defaults, rather than simply setting a measure which puts us in a position to better deal with defaults or better deal with over-indebtedness. And that's also something where borrower-based measures actually, in the end, were something we preferred. Now, the journey towards setting those binding borrower-based measures was relatively long. I mean, we had qualitative communications and recommendations. We had quantitative recommendations over the last couple of years. In 2014-15, we even had to set up the legal basis for doing borrower-based measures, which we didn't have before. The ESRB, by the way, was very helpful in achieving that because of the recommendations we got from that side. All the recommendation part, I think, in the end was ineffective. The competition was simply too strong to allow for reasonable lending standards to be kept in such a hot market environment. Banks were just faced with the situations, if they don't do the loan, the bank next to them does, and they would be losing market shares. And that's why in the end, I think borrower-based measures, making them binding, was the way to do it. I think the way we calibrated them, if you look at the numbers, a 90% LTV, 40% debt service to income ratio, maximum loan duration of 35 years. These are not parameters where I would say they are overly restrictive. I think if you look at other countries, you would stumble across a parameterization that is much more conservative. But it is still binding, I may say, and it's still binding, even very much binding, because of the environment we're in. We're having an explosion of construction costs that we are witnessing, and we are having a drastically different interest rate environment. And this, of course, makes measures that hitherto we would have deemed as a backstop, now very much binding. Here again, we considered whether we should do the counter-cyclical buffer as a substitute, but there again we tried to deploy the more targeted measure in terms of the borrower-based measures, because if looking at our indicators for setting the counter-cyclical credit buffer, the residential real estate side, those were really the indicators that were flashing red, and addressing them spot on seemed to be better than having a very broad buffer, which maybe wouldn't even tame the residential real estate cycle, but could, in banks' behavior, be reflected by a reduction of SME lending, because they would at that point in time deem that more appropriate and more profitable to go into real estate lending, which, by the way, is not something very very out of the box, because if you are in a turning cycle, residential real estate loans are usually not the one, especially the very young ones. Are usually not the ones that default first. SME loans would be at a much higher risk of default there, and a bank faced with capital constraints could have very well opted for that way. That was another reason. Now, I don't want to go into much more detail on the countercyclical credit buffer and conclude with an outlook. I don't want to talk too much about what I have on the slide here. I think we have some homework to do on the policy framework for macroprudential policy making, in the sense of being aware of the complexity in the system that we have at hand. I think this is, being myself also a macroprudential supervisor, something that is really an issue. It's very hard to use the toolkit and see all the ramifications that in the end it produces. One of the things with the capital buffer decision that we just made was, for example, the ramification that this had on the MREL requirements for banks, which was quite substantial in the end, as it turned out. Again, the resilience part, I think the discussion on a more releasable capital is a fair one, but I would see this as something on top rather than something being traded off with other more structural buffers. And I think something in Europe we should always be aware of is that it's not a good idea to deviate too much from the Basel framework. But in terms of the outlook, I would also have 2 or 3 thoughts on where we stand at the current juncture in terms of the future paths we would be likely to follow in macroprudential policy. And I think, having talked about the COVID pandemic before, I think we are in a very different situation to the one we had in 2020. And I think there are 3 issues that make this situation dramatically different. The first one is we had a de facto government backstop for whole economies over the developed economy and beyond during COVID. And this is something that is not going to be possible a second, third, fourth time, let alone for fiscal reasons. First thing. Second thing, I don't think that we are going to see a V-shaped economic development. Something that basically everybody in different forms was expecting in the COVID pandemic. I think the thing we are faced with, especially if you look at energy policies in the euro area, this is a structural change of the euro area economy, and this is not going to be associated with a V-shaped recovery in the short run. Second thing. And the third thing that is very different, and cutting a long story short and perhaps being a bit provocative, whereas monetary policy was part of the solution to the COVID crisis and provided a tailwind, it is now part of the problem, at least from a financial stability perspective. And that, all in all, I think creates a situation that is very different, in the sense that whereas the banking system and the provision of credit was something that happened on a very broad basis at the beginning of the COVID crisis, backed by government guarantees and so on. And I think this is something or let's put it differently. It would be something, if it happened in the same way, that would concern me, in the sense that my concern would be one of overburdening the banking system. I think in a situation like that, where we have increased levels of indebtedness 2 years ago, where we now are facing a dramatically different interest rate environment, and where governments are not in a position to backstop the economy to the same extent as we experienced it, I think banks have to be selective. And we as supervisors, and the banks, by the way, I think will have to stick to their guns. And as Carsten has said, I think we're in a very positive profitability environment for banks. 2022 is going to be a very positive year for banks, and we should use that to, within the banks, build reserves, be it in the form of loan loss provisioning, be it in the form of capital reserves, to go into a potentially difficult macroeconomic environment in a strengthened way. And that's why I think that the ESRB recommendation was coming at the right point in time. And that's also basically one of the reasons why we increased the buffers, because we wanted to send a clear message to banks that this is not the time of, paying out dividends in a very generous way. Stick to your guns, try to preserve the capital you have. Times are not going to be better than they are now. So I hope I gave you a little bit of an overview of how our thinking was over the last couple of years.
Well, thank you very much, Markus. I mean, not just for the backward-looking overview, but also for your last points, because I think this sort of forward-looking perspective goes very much also in the direction of our discussion. Okay, let's then move to Marek. The floor is yours.
Okay, Rainer, thank you very much for the invitation and also for being here and this possibility to discuss this topic. Several colleagues mentioned how important is this topic, and let me just echo on this, because I also agree it's a very, very important topic. I remember that during previous decade we had many conferences, workshops on macroprudential policy, and mostly it was about the real estate cycle, also about credit cycle. So after this decade, I think we know how to impose borrow-based measures, how to maybe increase some buffers, and how to prepare banking sector for, let's say, traditional downturn in economic or financial cycle. But the problem is that now we are facing very, very specific period, full of uncertainties, and basically a period that is quite, or we can call it terra incognita, because there are very, very specific new scenarios that are ahead of us. Title of the conference is about macroprudential policy and increase in interest rates. But from my perspective, I think the problem is much, much broader. And I think there was a question at the beginning whether it's only about interest rates. From my perspective, it's about energy prices and maybe other very important structural changes. Markus mentioned that monetary policy is also part of the problem, or increase in interest rates can contribute to the overall burden. Well, from my perspective, it's slightly, or I see it slightly different, because I remember that 2-3 years ago we had a long discussion, the ECB, ESRB, about low interest rate environment and an impact on the financial stability. And there is one very nice paper published by the ESRB showing that there are far-reaching consequences on the real estate market, on the indebtedness, on the financial markets, pension system, overall impact on the banking sector. So, and I think there was a broad agreement. Now, when we have final increase in interest rates, I think finally we have some normalization, because we need some type of normalization. Don't ask me what's the proper level of interest rate, but at least from financial stability perspective, we need certain increase in interest rates. Of course, there will be some pain, there will be some short-term pain on households, on corporates, but I can mention later on that when we tested households and corporates on the possible increase of interest rates, and a relatively significant increase, they have relatively sufficient buffers. So this should not be major source of the concerns for us, increase of interest rates. But other topics seems to be more relevant from our perspective. Okay, so my presentation will cover 3 topics. One of them I already mentioned. It's focus on the, let's say, present and future challenges that are in front of us, so mainly energy prices, and also we can speak about global supply chain disruption. Second topic is maybe more backward looking. So I will try to explain how we tackled the last decade of very strong financial cycle in Slovakia. So very briefly, I will explain how we impose borrow-based measure and also how we increase different capital buffers. I will also touch upon latest increase in CCYB, because that's basically the topic we are facing now, whether we should increase buffers at this time or not. So I'll explain what was the logic behind. And third topic that I want to open is, again, topic that has been discussed during the first session, how macroprudential policy should approach easing, or during the uncertain time, how we should approach possible releasing of the capital buffers or borrow-based measures. So I will try to explain how we approach this during the latest episode in the pandemic crisis. Okay, so first let's have a look on the on the past decade. So very short explanation. Slovakia is a country that witnessed very, very high increase in the lending and indebtedness during the past decade. If you take indebtedness of the household during the past decade, it more than doubled within 10 years. So you don't find probably any other country in EU or Eurozone with such a high increase in lending. Many reasons. First of all, very low or ultra low interest rates. And here in Slovakia, we had one of the lowest interest rates. At the beginning of this year, you could still have a housing loans for 0.5%, 0.4% in some banks. So extremely low interest rates. Of course, we have some specificities given here in Slovakia. Ownership rate is very high and tendency to buy own house is extremely strong here. So we don't have many alternatives. You don't have a rental market that could be a good substitute to the ownership. But fortunately now things are changing and now the government is coming with some new proposals. And also I can mention we have one very specific regulation that basically allows clients to refinance loan anytime. And we have a really big army of mortgage brokers, and they basically push people into this tourism between one bank and another. And all the time, or in most cases, it was linked with the top-up of the loan. So that also contributed a lot to the overall increase in indebtedness of the households. So very strong cycle, but at the same time, very active approach from our side. So from the very beginning, when there were first signs of the deterioration in the lending standards, that was already in 2014, we started with very active application of borrow-based measures. In 2014, it was recommendation because at that time we didn't have a mandate to impose binding decisions. So that was in 2014. Then we continued with several rounds of further tightening. The latest tightening was just a few months ago. It was focused on the tightening of DTI in some specific categories. I will not go into details of every tightening. What I just can mention that our effort was to keep the growing indebtedness in line with fundamentals of the household sector. That was our major point. That was the most important task for us. And maybe second point, I can mention that if I compare our decision in 2014 and 2022, very significant different situation, very different decision. In 2014, our decision was, let's say, rather cautious and shy, because at that time our knowledge about the system was still rather limited, because at that time we didn't have a proper reporting and no really proper understanding of what's happening on the market. So we just had a feeling that something is happening. We saw that there are signs of deterioration, and even calibration of borrow-based measures was more or less in line with the foreign practices. So we knew that LTV on average is, 70, 80. So we tried to impose in our sector. And at the same time, we try to stay in line with the current market practices, because that was very cautious also approach. Now, our system is very different because we have much more data about the banking system. We have loan tapes. Even our monitoring system is very different. We have new models to quantify pros and cons of the tightening, and we see also the effectiveness of measures. So now it's a very different approach, and really we go after specific risks that we see in the system. And I also see that the reaction of the public is very different now as it was before. So when we started in 2014, the culture was very different, because nobody understood what is preventive measure, especially in time when everything is booming, real estate market and also lending market. The understanding for macroprudential policy and tightening of borrow-based measure was very different than it is now. Now, I think after 10 years of very transparent policy and very open communication, how we see the risk, the openness of the public and also here in Sweden Bank to tightening is much better than it was in the past. So, in terms of capital buffers, we also applied several buffers. First, two structural buffers, conservation buffer and also buffer for large systemic banks. We started already in 2015 with conservation buffer, but it has nothing to do, of course, with financial cycle. It's simply coincidence. It's driven by the fact that at that time we received this possibility to apply it on the bank, the same with systemic banks. Marcus mentioned that you started in 2015-16. In our case, it was at the beginning of 2016 when we imposed buffer for systemic banks. But what is more important and what is a really typical macroprudential buffer is countercyclical capital buffer. And here, as you can see, we were quite active also in this field. So we started in 2016, and the latest decision was just a few months ago during the summer of this year. We increased CCYB to 1.5%. Just few remarks to the latest decision, because several colleagues opened this issue, but this is a really good timing to impose it. Well, from our perspective, data were rather clear. Because already at this time, I mean, the cycle was still extremely strong, and there were very clear signs of excessiveness of the financial cycle. Of course, but there is a question: are you going to impose new capital requirement when you have such an uncertain time? So we had long discussions about this, and but finally we decided that banking sector is in a very good shape. Macroprudential buffers, or generally management buffers, are very high. Even perspective of the profitability is very good. So that's why we decided to go ahead with this decision and to increase resilience of the sector. So if I summarize the last decade, after this very strong financial cycle, I think we have a banking sector that is in a very good shape, that is very resilient. Capital buffers are relatively high, and despite the fact that we had very strong cycle and pressure on the lending standards, quality of the banking portfolio are very sound. And not just in terms of NPL, but also when we do different stress scenarios, forward-looking stress scenarios, we see that most of the clients should sustain even a very dramatic increase in interest rates or in other factors. So that's a very positive story after 10 years. Okay, second topic is slightly different, and that's what Vice Governor mentioned, that we have experience with, let's say, one part of the cycle with the tightening, but very limited experience with the easing of the macroprudential buffers, or generally with macroprudential policy. I think there is a general consensus that there should be no easing of borrow-based measures when you are in time of uncertainty. I think just few countries released borrow-based measures during the pandemic era. I think Czech Republic was there, but you had some specific reasons for there. But most of the countries remained borrow-based measures on the same level, simply because borrow-based measures are mostly structural measures. They are not so cyclical, mostly structural. But capital buffers and a CCYB, this is something different. So let me explain how we approach releasing of the CCYB during pandemic era. We all remember this period. It was a shock, especially first month of 2020. From 1 week or from one day to another, the whole economy was closed. I think there was a very positive effort from the government, also from monetary policy to support corporate sector, also banking sector. And at the same time, there was a tendency to release some requirements also from a regulatory point of view. We know very well that at the beginning, ECB released some capital requirements from micro perspective. And at the same time, there was a question, should macroprudential authorities also release capital buffers? And indeed, several countries released capital buffers, not just CCYB, but also structural buffers. And reasons were very, very clear. I think reasons were, okay, we are entering very uncertain period, and if there are losses in our portfolio, there can be pressure on the capital, and if banks are under pressure in terms of capital, then you can expect some credit rationing. So it's better to release now and do not put banks under this pressure. Maybe the negative point about this approach is if you release capital too early and there are no losses, then banks end up with excess of capital and you have a potential outflow of the capital. So we had a very long discussions in our bank how to approach, because really there was a pressure, and I remember I received several calls from the ECB, also from the IMF. Look, many other countries already released their buffers. They are on the level of 0. You are the last one. You are the last one that you still have a non-zero CCYB. Well, our first decision was to revoke for the increase, because there was a period when CCYB was on the level of 1.5, but there was a decision to increase to 2%. I think the decision was from it was from 2019, but still was not in place. So we revoked increase, and we slightly decreased to 1.5. But there was a further pressure to release CCYB to zero. So how we approach this issue? So first of all, we try to analyze how serious are these risks that I mentioned. So that means to analyze whether capital is really under pressure in the banking sector, whether there is really a risk of the banks being capital constrained, how far banks are to credit rationing. So our point was really to spend a lot of time with banks to understand the situation in the banking sector and to understand how much capital they have for the credit. So what we found is that at that time banks were still in very good position. The profitability, despite the fact there was some increase in provision, was still relatively good. Even perspective of the profitability was very good. When we also asked banks about their capital position and also the management buffers, at that time, I think management buffers were around 5 to 6%. And there was no pressure on the capital buffer. So banks at that time were in very, very good position. So there was no immediate pressure on the capital, on profitability. At the same time, government announced, I think it was around this time, announced very strong and significant measures supporting corporate sector and also household sector. So there was no even immediate risk of some losses in the bank's portfolio. So the risk of potential losses was not so high at the time. So at the same time, you should remember that CCYB is relatively flexible too. So if there is a situation that you have a sudden increase in the losses, you can within one day to another revoke this increase and again reduce CCYB. So our decision was very much influenced by this analysis and this really in-depth monitoring. So we decided to keep the buffer on the level of 1%. And also specific situation for Slovakia was that in case of excess of capital, the risk of the outflow of the capital was relatively high. You remember that at that time, ECB and ESRB also introduced a recommendation for distribution of dividends, but that was only for the home countries, not for host countries. So from our perspective, we also try to do everything just to conserve capital here in Slovakia. So that's a case study for release of the CCYB during the pandemic. So the final words about this, of course, it's not black and white picture. For every country, it can be rather specific, but from our perspective, I think too hasty decision would probably lead to outflow of the capital. So from our perspective, it was better to keep resilience of the sector as it was at that time. And of course, in case of losses, we were ready within one day to another to release capital and to allow banks to deep into this capital. Okay, and the last part is about present situation and also about let's say some changes that are happening now in the economy, in the global market. I think from the first two slides, it was clear that we know how to tackle normal financial cycle and economic cycle. We know how to impose buffers for traditional risks that are related to excessive lending or, increase in the real estate market. That's what we know. That's what we learned after the past decade. At the same time, we know that our task is to maintain financial stability, even in severe scenarios. But the question is, what are the next severe scenarios? We probably will not talk about increase in the real estate bubble or, excessive lending, but the new scenarios will be very, very different from what we know from our guidelines, from our textbooks about macroprudential policy. And the question is how we should tackle these new scenarios. So what can we expect? What we see now is really huge disruption in energy markets, mainly because of the war in Ukraine with Russia. We see that energy prices are very high, and as Marco mentioned, probably it will not stay or it will remain like this for a very long time. And this is a very important factor because I think corporate sector in EU in general or our economy are basically also built on relatively low prices for energies. And now when you have such a high increase, that's a really significant structural change for the whole corporate sector. At the same time, we see that there are growing tensions, not just in Ukraine, but also in Asia. We see that there are growing tensions between Taiwan and China, possibly also with the US. And if you put it together, we see that probably even global trade will be under threat. And it's another pillar for our economy, for our corporate sector. So if you have a scenarios that could potentially disrupt or break two basic pillars of our economy or our corporate sector, these could be very, very dangerous scenarios for not just for fiscal policy, for monetary policy, but also for macroprudential policy. I don't have an increase in interest rates. But I mentioned at the beginning that this is definitely a scenario that can bring some costs for financial stability, but from the long-term perspective, I think that certain normalization is needed. That's what I mentioned at the beginning. And also I mentioned that when we quantify the direct impact on the corporates and households of the rising interest rates, I think that they have sufficient buffers to tackle this issue. So we see there's one part of the mosaic, but not probably the most dangerous for financial stability in Slovakia. So what can we do about this scenario? Again, I don't have answers. We can discuss this, but it's even very difficult to quantify it, because when you speak that we should have a resilience for scenario, try to quantify scenario of the war between Taiwan and China, or breakdown of the global supply chains or global trade. What can happen with macroprudential policy? Just one example, because what we tried is to quantify one scenario, and it's a scenario that is relatively plausible. So we try to quantify increase in inflation, significant increase in energy prices, and also some economic disruption in domestic economy. So what we did, we basically took market prices for electricity and we directly applied it for the corporate sector. Of course, we assume that part of this increase in the cost for corporate sector will be also transferred to the prices, but only to the limited amount. Good thing about this scenario or this analysis is that it's done on individual data for individual corporates. So we see balance sheet of corporates, we see the revenues, we see also the expenses, and you can directly impose shock to the expenses. And also you can change turnover of the companies. And we have relatively fresh data for some companies end of 21, but for many companies also June 22. So relatively good data set. Results show us that the potential impact would be very, very dramatic. In this picture or in this chart, you can see impact of the scenario I just described on the corporates that are in the bank's portfolio, and this is the impact on the financial position. We call it loans at risk. And basically that means that if you are at risk, you are in very difficult financial position and you generate losses that are even higher than your capital. So basically you are in technical default. So almost or between 30 to 50% of all corporates in bank's portfolio could be highly vulnerable to such scenario. And that's very, very high number. Of course, we are not saying that all these corporates will default, because they still have some other sources how to survive. And we also see in our portfolio that many corporates that are in technical default, they are still able to pay their loans. But the story that we want to show here, that if there is no government support, and if there is direct application of the current market prices for the energy and also inflation for next 3 years, the impact on the corporate portfolio could be relatively significant. So what can we do about this? Because we have a macroprudential buffers, but if you think about macroprudential buffers, well, CCYB can be imposed by 2.5%. Systemic risk buffer can be slightly higher, but they should be imposed only on part of the portfolio. So macroprudential policy is basically not suited for such scenarios. Even our guidelines written by ESRB or interim guidelines show us how to react to, let's say, traditional recession or traditional downturn in economic cycle, but we are not really prepared in terms of our toolkit for such scenarios that could potentially occur. So what can we do about this? That's the last slide. So that's what I mentioned already during the previous slide. So we have tools, but they are really suited for traditional risk categories that we were dealing during the past decade, but not probably these new types of the risk. It's some preliminary results showed us that buffers can help a lot, because I also mentioned at the beginning that the resilience of the banking sector is very strong, but it seems to us that can only partially cover some of the losses in case of very extreme scenarios. So as a result, it seems that it's not just in our hands, but of course other policies have to be very deeply involved in the solution of such scenarios. Of course, first of all, it's about fiscal policy and government policy. And what we can do is really to try to shed more light on these scenarios, try to quantify possible outcomes of these scenarios and very openly communicate to public and also to policymakers, look, if you don't do anything, such structural scenarios can really be a threat for the financial stability. Okay, I think I will stop here. Thank you.
Okay, thank you very much. So let's move on to the last presentation. Yeah, the floor is yours.
So I'm pressing the green button for a red light, so it's somehow symbolic. Good afternoon. In the introductory remarks, Ludovic Odor explained that there could be two corner camps of central banks. Some could suffer from inaction bias and some could be overly excessively active. I think no one thinks that the Czech National Bank suffers from inaction bias, and whether we are too active, I will leave it up to your assessment. I was instructed to talk more about monetary policy and monetary policy, not about macroprudential policy, and I will do it with great pleasure. And because it's a pretty late time, I will try to be non-mainstream, a bit provocative. People have different views on the links between monetary and macroprudential policies. Some, like me, would like to see a joint conduct of these policies because they think that these are just the two sides of the same coin. Some would like these policies to have closely coordinated, and some still think that these are separate policies that should be conducted autonomously. The Czech National Bank approach over the years was clearly a coordination, which means that, for example, Monetary Policy Department provides the board with written opinion on CCYB policy, while Financial Stability Department from 2017 provides a written recommendation on monetary policy. And these opinions are not always in line with the main recommendation. So it is a lively discussion. So as to the policies, if you look at the right, there is a CCYB rate. We were tightening macroprudential policy step by step after the introduction of this policy in 2014. We loosened that policy during the COVID times, and we reintroduced a pretty high rate recently. The loosening of the policy in 2020 was not in line with our methodology, which clearly is saying that we should do it only if we see systemic losses. With it, nevertheless, loosened the policy, and we currently communicate to the banks, don't expect us to do it second time. So this time, next time, we will stick to our methodology. As a matter of fact, as Marek explained, we had loosened also borrower-based measures during the COVID times, but it was a bit political economy situation, so it was not the outcome of economic discussion. But again, we retightened borrower-based measures recently. As to the monetary policy, you can see it on the left. I think the blue line is our key monetary policy rate, while I also figured there a 5-year Czech government bond, which actually shows how policy is transmitted to the rates which are important for mortgage lending. So the monetary policy in the last 10 years was quite loose. We had this roughly zero rates and currency commitment till 2017, then some tightening, and again nearly zero rate policy in the COVID period, and significant tightening in recent months to 7% policy rate, which is there now, and the long yields continued in the rise to 5 to 6% recently. So this is a relatively tight policy. And now to more provocative discussion. I personally believe that monetary and macroprudential policies are the same coin, the same side of the same coin, and these days, and I do think that joint conduct of these policies, such as in Norway, is desirable. I do believe it for a long time, so I'm telling everyone that 20 years, and I will keep telling these people. And I don't believe in Jackson Hole consensus, and I even wrote a paper in 2011 hoping in a new consensus in monetary policy. I was completely wrong. So there is still a Jackson Hole consensus, although slightly modified. I think that the separation of policies, this dichotomy between monetary policy and prudential policies, is a side effect of developments in macroeconomic modeling in the last 40 years. And in particular, the predominant models inspired by new neoclassical synthesis and reflected in new Keynesian DSG, I think made people believe in that consensus in a style, no alternative, kind alternative, simply. And this is a herding behavior of economic and central banking community. So this is, we always warn against herding behavior. We were behaving and still behaving in a herding styles. So everyone is using roughly the same modeling approach, despite the fact that this is the modeling approach that was created by Americans under a specific American situation. So I think that these models are rather incomplete, oversimplified, and somewhat misleading in critical times. The problem is that a lot of things that we discuss each day as macroeconomists is missing in this model. We know that, and people who use these models know that. But there is some kind of psychological effect that if something is not in the model, people do not place much emphasis on that, and they start losing sight as to these things. So we don't have debts, we don't have much credit there, and so on and so on. And I think it's at the end of the day, it provided us sometimes with misleading recommendations. And this model is also pretty naive. So some people, like the author of Maradona, Theory of Interest Rate, believed that we can stay with the same interest rates throughout the whole cycle. Well, I think it's a pretty naive idea, and I'm really surprised that some people still subscribe to it today. My view is that these modeling approaches lack important features of macroeconomics and true capitalism, and employs some features that were purpose-built to operate these models, not to provide reasonable economic recommendations or simulations. And the forecasting and simulation exercises in some cases resemble technical analysis of financial markets. It's not a fundamental economic analysis. And this has actually unpleasant consequences for our policies. So we have apparent failures in forecasting macroeconomic dynamics, and we failed in understanding scope of disinflationary and the inflationary pressures, and we failed in spotting structural shifts in inflationary forces in recent years. And to be honest, I don't think that those central banks that have inflation targeting do in reality do inflation forecast targeting. It is just something in these fancy academic papers. Most central banks that do inflation targeting respond primarily to recent inflationary pressures and often getting behind the curve and sometimes moving from one extreme to another. Okay. The other problem is that we believed many years ago that independent central banks and inflation targeting would prevent us from time inconsistency in monetary policy. I don't think it happened. We are suffering from time inconsistency in a way that we are trying to find reasons why to keep interest rates low most of the time, no matter what is happening in the economy, unless the inflation is high. Once the inflation gets high, surprisingly as now, we are shocked and we try to find some strong steps, or define some strong steps, sometimes in rhetoric, sometimes in reality. I think that macroeconomists were abusing some concepts like productivity growth, and in particular natural real interest rates R-star concept. And it was a pretty opportunistic explanation sometimes used. And actually, I'm a relatively old person, so I remember very well the so-called new economy ideas 25 years or so ago, saying interest rates can stay low because the productivity increased thanks to internet and all these technologies and so on. Then we had a outcome of this kind of belief. It was partially, at least partially, cause of the global financial crisis. Then we had some specific changes, and out of sudden we moved to the opposite view. We have secular stagnation, and because of decline in productivity, we have to have rates low because R-star declined. So I don't think it's, my view is, for example, that these empirical estimates of R-star as presented, and for example in the Fed website, it's a kind of intellectual fraud actually. So the BI is not willing to say it. I say it. Yeah? So it's an intellectual fraud. The other problem with we focus in monetary policy making on very short horizons. One reason is because we don't know how to predict inflation in the longer horizons. So we look at short horizons, and this enables us to disregard the risk of multiple equilibria. So, for example, risk that very expansionary monetary policies at the end of the day could end up in both inflationary and deflationary situations. So if we focus on a short-term horizon, so we always can support macroeconomy, the economic activity by cutting short rates, then long rates, then let's say moving a lot of liquidity to the sector, and we can do it indefinitely because if we start each quarter again looking only at the next 2 years, but this is again intellectually somehow unhappy. Okay, and no, sorry. In this case, I think macroprudential policy became a kind of side door to monetary policy for some. Including myself. okay, we could try to go through the main door, but it seems that the attempts to employ financial factors in predominant macroeconomic models were not particularly successful. I mean, the attempts to let's say modify reaction functions, policy rules to cover the financial sector, the credit dynamics, and so on. There were nice papers. For example, Michael Woodford published that in 2012, I think. Or there are very nice research papers by biased economists. But it doesn't seem that it affected macro modeling community. So in this case, why don't use macroprudential policy as a second channel, as an ally for returning into central bank policies credit and wealth distribution, which are post-Keynesian topics, and money, which is a monetarist tradition. So I think this is sometimes happening, and it is understandable. Also, the borrower-based measures and partially capital tools may erect some barriers to credit money growth if higher interest rates are not available. So this is, I think, no one is sometimes willing to tell it, but it is. And of course, we have a significant part of money creation these days is stemming from government borrowing, public sector borrowing. We could maybe find in macroprudential policy way how to tame it through concentration limits or public finance stress tests, but I'm not that naive to believe that it is easily available policy. Okay, and maybe last thing, the macroprudential policy is centralized along idea of buffers, and it's even kind of asymmetry. So that's the policies are not viewed as necessarily symmetric. We can extend this also to monetary policy. One natural way is for small open economies or emerging economies to build FX reserves and to use it for both monetary and macroprudential financial stability purposes. The Czech National Bank built huge exchange reserves, maybe by accident, but it is the fact, and we currently use it as a shock absorber. It is not uncontroversial, but it is funny that we have periods when the analysts are saying, your reserves are too high. You are printing too much money when buying exchange reserves. And then some shocks comes and people say, okay, are your reserves sufficient? You should not sell exchange reserves because you are burning precious reserves, precious buffers. So you never please people, but these days, they think it is useful to have pretty high reserves if you are not a member of a monetary union or some other area. Maybe some last points coming back to current situation. The mix of extra loose monetary and fiscal policies during COVID created what I call fear of inflation. So people in this area are actually quite cautious when. So we don't like inflation here in this part of the world. So people seeing combination of low rates and very supportive fiscal policies start to hear about inflation, and they moved to bricks and mortar at a very high scale. So if you look at the left chart, you can see, sorry, in the right chart, you can see the the blue line, the house price index, which was going up nearly linearly for years, but it was nearly exponential last year. And also the red line, the growth rates were one of the highest in the world. And in real terms, I think we are one of maybe the first one, number one in the world, is to the growth in last 5 years. So we responded first by monetary policy, by increasing lending rate and of course policy rate, and it affected on the left the lending rates, so mortgage rates on new mortgages are now between 5 and 6%, which is quite a lot. And we also tightened borrower-based measures. It works. So if you look at the left chart on this blue line, it is year-over-year growth of new mortgages. So it went to very low levels recently, and it is still trending down in these weeks. So it works. So if you want to tame mortgage credit growth, so using rates together with monetary policy, borrower-based measures, it works. Nevertheless, you still cannot expect that it will affect immediately the real estate prices. So if you look at the right, in the second half of this year, the transaction prices were going significantly up. So it could be a delay. There could be a delay in response of the market. So it seems that we can see some stabilization these days, but without assistance from other policies, in particular taxation or fiscal policies, it may not be that easy to achieve a desirable outcome. And that returns me back to the idea of holistic approach to macroeconomic policy making that is present often in the BIS papers. So that's where I would like to conclude. And if you would like to read something about monetary and macroprudential coordination, please look at the papers I provided at the end of the presentation. We published quite a bit about this in recent years. Thank you.
Thank you very much, Jan, for bringing also a somewhat different perspective and indeed some provocative views here to the room. That's great. So, any questions in the room, first of all? Anybody who would like to comment? Yeah, Pavel, please. I think we just need the microphone.
And I liked the last presentation very much, I have to say. But to me, it was not as provocative because, yeah, the mandate of monetary policy is maintaining price stability. I see more or less, and it has never been said or that actually what's the role of macroprudential policy? It's to maintain the asset stability, asset price stability, more or less. So, well, that's because assets are not part of the consumption basket. So it sounds to me kind of exactly as you say, the same side of the same coin. So I would completely take your argument, but the only thing I kept thinking while you were had your talk was that well, how do you deal with the different horizon of the two policies, because the cycles are a bit different. So but this is what has been discussed widely across the panels here. And second question is perhaps to all the panelists. And here in this country, we understand that, and it has been also reiterated a few times that we are expecting some profitability of banks across this and next year. Do you see also, in this country, do you see also any other candidates who would like to extract this profit from the banks before macroprudential measures do so?
Thank you, Pavel. Any other questions? Yeah, please, Carsten.
Markus, you mentioned you prefer buffer use instead of release. But I mean, there's some research also, I think was cited by Christopher Erschak, also Coyer et al., who show that really if you want a lending effect, let's say, then it's good to really to release the buffer, to increase the distance to the MDA threshold before distribution restrictions kick in. And do this in a predictable way. So they have some results showing that works much better with, let's say, a traditional tool, which is meant to be released and where there's some uncertainty when it will be reinstalled again. So I'm just wondering whether you thought about that and how important you think such results are. Then just a question to Marek on, you mentioned these new challenges. And I would support that these are very important considerations, global value chains, etc. Perhaps we are in a world of much steeper Phillips curves again, forever, or for a long time. The question is, are these considerations already somehow reflected in your calibration of macroprudential buffers? And I mean, you mentioned something like 2.5 would be a maximum for the CCYB. And of course, CCYB can go anywhere. But does it mean, if you say it like this, that you're concerned about the lack of obligatory reciprocity above 2.5, or why is it constraining you? And then a question to Jan. I mean, I must say I have a lot of sympathy with many things you mentioned. Also, I don't trust the R-star estimates. I think indeed the monetary, when we had a previous strategy review and we abandoned, say, the two-pillar strategy, some people suggested, why not relabel the monetary pillar into a financial stability pillar? And then we're back there. And we, again, can have some emphasis on quantities, which were going to vanish from the analysis. So I think something going in your direction. But nevertheless, I think there are situations where it's not the same thing, where macropru is not only the same coin, but different side of the same coin than monetary policy. I mean, take this example I mentioned, when in times of low interest rates, you need very accommodative monetary policy for your price stability objective, but you see side effects coming up. And then you would still loosen monetary policy, but you tighten macroprudential policy, and that is the optimal mix. So it's not going in the same direction. Or indeed what was mentioned before on the different length of the cycles, business and financial cycle. I think that this creates situations where you might, due to the different purpose, might react in not fully aligned, as you mentioned it would be most of the times. And finally, also, I mean, coming back to the question from Jan before, supply versus demand shocks, also that indeed could create situations where monetary policy is reacting differently from macropru. Macropru would just look at the vulnerabilities being existent or not, while monetary policy might indeed have to take into account, is it a supply, is it a demand shock? If not for the sign of the reaction, at least for the strength of the reaction. Thank you.
Okay, that was quite a few questions, but maybe we add one more, yes?
No, after such hard questions, I have just two very easy questions. Whoever. First is that if you expect any pressure on financial stability from micro supervisory tools forthcoming, like increasing risk weights, increasing Pillar 1 requirements because of some negative development of the economy. And the second one is that when we talk about non-financial corporations, whether if now there will be some losses, I can expect some discussions about BBMs to non-financial corporations. Do you see any reason why to introduce such measures? Because I'm not sure it can work in the same way as in case of households. Thank you very much.
Thanks a lot. Let's give the panelists a chance to respond, because I think this was quite a few already. Maybe Jan, do you want to start this time? Just in reverse.
Okay. As to the mandates of monetary and macroprudential policies, as I say, I'm a relatively old person, and so I remember monetary economics prior to this century, and we didn't have price stability and financial stability. We had monetary stability that, in the view of countries like these in the region, was a mix of low inflation, stable currency, and stable banking sector. So that's this separation is the outcome of this century, and it may not be permanent. So I think that at the end of the day, both policies should aid as keeping money sound, and keeping money sound means also keeping financial sector sound. So we had seen a lot of excesses in financial sector, and currently we saw some excesses in inflation, and this could be to some extent the outcome of this philosophical separation. So I'm not saying that these are two same policies, something like this, but I think that we should not separate them that much. Because at the end of the day, what we want to have safe money and sound, or sound money and safe finance. As to the horizons, of course, it is generally believed that the financial cycles are a bit longer than economic cycles. Difficult to say these days, because we nearly removed economic cycles, and I think the swings in financial variables are also more frequent than they used to be. So we will see. But of course, both monetary policy and macroprudential policy and other policies have short-term effects, medium-term effects, and long-term effects. And we should actually focus on all these horizons, not just on the most important ones, because maybe we don't know what is most important. So some monetary policies we saw in previous decade could have significant impact 15 years ago from now, actually. So that's the possibility, and therefore, at least conception. We should look at least in research on all these horizons, and try to understand how the interaction of these policies may affect the economy even in the longer horizon. As to what Carsten was saying on the length of the cycles and so on, of course we have papers published as a methodology or communication of the Czech National Bank, that we have situations when the policies are not two sides of the same coin, when they get into conflict, or should even be desirable when going into opposite direction. But what I think it is not a situation when the labor market is overheated, they have a shortage of labor everywhere, when credit goes fast, when real estate prices are going fast. So that this is not a situation when the interest rates should be kept low or negative or something like this, despite the fact that the inflation is relatively normal. So that's I labeled that these days, and so because I think these days or the previous days, the monetary and macroprudential policies should be conducted jointly, so not every time, anytime. So that's I fully agree. Well, and then next two questions, very briefly. Of course, banks do have profits, in particular in countries such as the Czech Republic, when we provided a room for increasing lending margins, and not surprisingly, government is looking at the profits and thinking about taking some profits away from shareholders, in particular if there are foreigners. These are foreigners, and so we have a debate about windfall tax in the country, and we just advise the government or Minister of Finance not to be mechanistic, I would say so, because some banks, in particular smaller institutions, have only profit to cover capital for credit expansion and for meeting requirements, including MREL. So that's our communication. At the same time, we don't think that the profits would be historically so abnormal, but it will have to be proved by the reality. And last question was about borrower-based measures and non-financial corporations. Well, the fact is that the banks in Europe lend mostly to finance real estate purchases and development, so either residential or commercial. So I think it is quite normal that 20 to 25% of loan lending books are to development and commercial real estate. So, and I think in this segment, the borrower-based measures are to be actually, let's say, considered. So that's it could be different in different countries. For example, in the Czech banking sector, the exposure of banks to commercial real estate is pretty low, and because the banks were not competitive in recent years, so there was so much liquidity everywhere coming from abroad that the local banks were not competitive. Simply, they were not successful. Hopefully, fortunately, sorry. Yeah, so that sometimes low activity is a good thing. So, thank you.
Okay, several questions. First, Carsten, about these new challenges and how much they're accommodated in our calibration of macroprudential tools. Well, directly they are not accommodated, partly because they are new, so the whole situation is very new, and also the data I show you in this chart are quite new and still a work in progress. Indirectly, they are accommodated because we have a conservation buffer. We also buffer for large systemic banks. So, and those buffers are really for unknown risk, and basically we can also discuss this is something really unknown for us. But the problem is that when you read methodology behind buffers that we have that are available, like CCYB or partial so systemic risk buffer, they are not used. I mean, methodology is not really written for these types of the risk, especially CCYB, and also the size is important. Hopefully, I mean, we'll continue with the analysis of this data. Hopefully, the impact will be much lower. We'll go even further to try to quantify default risk, not just loans at risk, but having in mind the size of potential losses in certain scenarios. Probably typical macro buffers would not be enough for this. So we probably will need something else beside this. Then there was a question from Jan about some kind of tightening of from microprudential perspective. I do not expect any, let's say, intentional tightening, because normally micro, when there is an uncertainty or there is a crisis, they do react in opposite ways. So they are looking for some easing, at least in some areas. But of course, the regulation is as it is. So once you have a losses and you have some macroeconomic uncertainty, you can expect increase in the risk weights. And of course, especially in the IRB banks, and this would have also impact on the capital position of the banking sector. Then there was a question of borrow-based measures for corporates. Well, I think that's a question that has been discussed even before on different forums. But as you also mentioned, well, we can discuss about effectiveness, especially if you compare with households. For households, it's relatively easy because you are talking about portfolios of clients that are more or less the same. Their behavior is quite similar. In case of corporates, you have a huge heterogeneity. Even in one sector, you can have a significant differences between two corporates. So it's quite difficult to impose one LTV for corporates or even within one sector. And then last question from Pavel about potential taxation of banks. Well, you know very well that now we have in Parliament one proposal that should cover sectors that are under the regulation. So far, banks are not in this proposal. But you never know. You know that government is very hungry for any income, potential income, and banks are usually very easy targets for politicians. So hopefully it will not be included in this proposal, but you know the situation in Parliament here in Slovakia. Okay, thanks.
Thank you. I'm not going to add on the taxation issue. I think you made a very good point there. I'm also not going to add anything on the borrower-based measures for NFCs because I think the situation is really different there. And I may say also that we've looked in Austria on the systemic aspects of lending to private households, real estate lending, and on the corporate side. And there are also differences there, whereas the private household side is systemic, the corporate side is not, at least at this point in time. On your question, Carsten, I think what you're basically saying is that there is this market perception that as long as you have the risk of dipping into MDAs, that is a problem. And you need to lower the MDA threshold for banks really to be willing to lower also their capital and to take the capital headroom that they have in effect for lending purposes. Perhaps a theoretical argument and a practical one. On the theoretical side, I don't quite get this because dipping into the MDA means making losses. Now, I can't really see how a bank that makes losses distributes capital. I do see the point that as a shareholder, I may relatively early after the bank has dipped into losses, I like to have dividends again. But that then means that the buffers are not rebuilt. If these buffers are at some point in time rebuilt, I will have to accept a lower dividend anyhow as a shareholder. Now I can put on this rebuilding of buffers the tag of dipping into the MDA threshold and getting out again, or I can put on it the tag of I release the CCYB and then I rebuild it. I don't think that in the end it makes much of a difference, with the exception of the fact that in the way we currently use the CCYB, the CCYB in the build-up is like an oil tanker that is speeding up. It takes a very long time for the thing to get into operation. Just think about this 1 year ex ante period that you need in the regulation to basically for the thing to come into force. But it is a very agile speedboat in stopping. And that is kind of the thing where this trade-off comes in that I mentioned earlier on, why we tend to have the preference for the structural buffers, that with a banking system that does not have the capacity to change its capital planning in a very agile way, you want to err on the safe side and rather see this these buffers as a signal maintained so that it's clear that at some point in time they have to be rebuilt. On the theoretical model side too, I think there is really this rebuilding of the buffers sometimes missing. You need to look at that too, and at the cost that this entails. And as a last practical point, I think you can accept the fact that things are the way they are and the market reacts the way it reacts. But still, if we want to change something, I think we will. We should think about the role of AT1 capital. That is, I was never a fan of AT1 capital. I think you'd rather have CET1 capital or debt capital, but not the in-between kind. Because this is really, I think, what this MDA threshold is about, and I think we should solve it. In Austria, by the way, even in setting, because the macroprudential buffers are in CET1 anyway, but we try, at least for those banks where we think that problems might arise, we also try to set microprudential buffers only in CET1 capital, because I don't think that AT1 capital is of any use in a crisis situation, and it's also bad at giving signals, by the way. So I'm not really convinced that this is that this capital structure that we require today is really something that we may want to preserve in the long run. I think there is some adaptation that we will need in order to fix this thing. And I think you had a question on the micro tools, on whether they might exert some pressure. Definitely, I think we have a very strong element of procyclicality being built into IFRS. That is something that we could face even in the short term once these stage transfers kick in. On the RWA side, I think it's not that much a short-term issue, but it's a medium-term issue, because we had a huge decline and we saw it, I think, in many countries. Just look at the RWAs of real estate loans. We had a huge decline in a lot of countries as those low default rates factored into the models. And if things finally reverse for whatever reason, I think this will also take time to then be reflected in the models. But at some point in time, it's going to be. I don't think it's a bad thing after all, because RWAs in the single digits for real estate lending is I think nothing that is sustainable in the long run.
Okay, thank you very much. So I have some good and some bad news now. The bad news is, unfortunately, time is up. I think we could discuss this for much longer, but we have already exceeded the timeline. The good news is there is some nice Slovak wine outside. No? Upstairs. Okay. So for those of you who would still like to join us, you can join us and have a glass of wine, and then we can maybe continue this discussion. Strictly optional, of course, but you're cordially invited to do that. So then let me close by, first of all, thanking, of course, the speakers and the moderator of session 1 as well, Fatima. So then very much also Ernest and Jan, my scientific co-coordinators for this event. So this was a great pleasure. Ernest, do you want to say anything on behalf of SUERF on that occasion? Or?
Thank you very much.
Oh, thank you. And then let me also thank, of course, Dragana. Thank you very much. And Martin. And also Vicky and the IT team here at the NBS. Because if you see all these cables and machinery, we're 2 years into a hybrid world, but it's still not that straightforward to get these things done. So actually and I think it worked all seamlessly on the technical side. So big thanks to them. And of course, last not least, big thanks to the audience. And I hope you enjoyed it. I found this a very insightful event, and yeah, hope to see you again soon. Thank you very much and have a good evening.